Okay, so good morning, everyone, once again. Uh, Today we are going to study tax base and taxable income. So just to clarify, when you use the word tax base, basically you're referring to that, uh, you know, the amount of tax on which the amount of your taxable income, amount of your income, which is basically taxable, uh, uh, and on which the rate will be applied. And base also refers to basis, because person's residence and the source of income, it could be geographical source of income, those things matter. So these are the learning objectives today, are determine the taxable income for resident and non-resident persons, first of all. So that refers to tax base basically. Second is examine the permitted adjustments and those recognizing the circumstances in which deductions for expenditure will be limited or denied outright. So naturally, when we are calculating the corporate tax, you are allowed certain deductible expenditures. So we will look at the deductions as well as to which deductions specifically are disallowed. That is a very interesting way to say that all deductions are allowed except for certain specified disallowed deductions. And then third thing that we are going to look at today is determine the rate which is to apply to taxable income and the threshold before which the tax rate is applicable. So basically application of rate and how much amount will be zero rated. So that's what we're going to look at today. Let us go to corporate tax base, which is Article 11. So actually, I don't know why is it written as Article 12, but actually it is Article 11. Let me show it to you. Uh, yeah. So if you so this actually what you're looking at is a book that I have almost prepared. It will be printed soon and it will be available for purchase in the open market as well as you know perhaps on Amazon, but I will let you know guys later on. So please remember there are two particular articles. One is Article 11 on taxable person, that gives the type of taxable person that we have to look at. In that, resident, non-resident, etc. is identified. But then there is again another article which is 12 that talks about corporate tax base of those resident person and non-resident person. So interestingly, the course has started directly from Article 12. Let us go through this. Article 12 introduces the corporate tax base concept. The first is a juridical resident person. Okay, so actually the Article 11 was covered in the previous lecture. So that's why they started off directly with the tax base. The first is a juridical resident person. The juridical resident person has a few different definitions, all contained in the following list. Let us have a look. A juridical person that is incorporated or otherwise established or recognized under the applicable legislation of the UAE, including a free zone person. So any company, any entity that is incorporated or established or recognized under UAE law, that will be called a juridical person, but it will also include free zone persons. A juridical person that, and another category is juridical person that is incorporated or otherwise established or recognized under a foreign jurisdictions laws. So foreign companies basically, but which are effectively managed and controlled in UAE. So if you recall, under Article 11, this is what we had studied. The three types of residents we had studied. If I can, you know, request you to recall it. So one were domestic companies and then there are foreign companies. So first category is domestic, UAE domestic companies. Then there are domestic entities and then there are foreign entities. A resident natural person is the one who conducts a business activity in the UAE. So yet a third category of the resident persons was natural persons who do business in UAE. If a natural person has a base or a permanent establishment outside of UAE, that is not taxable in UAE. That will be out of scope. So let us have a look at this again summary. Resident person, UAE, the UAE understanding of a resident person is set out in determination of tax residency cabinet decision number 85 of 2022, which was issued on 2 September 2022 and it effective from 1st of March 23, as well as another decision which is called ministerial decision number 27 on the implementation of certain provisions of this previous decision, cabinet decision number 85. So some criteria has been provided there. These decisions are available, but generally speaking, what you understood was quite enough, at least for your understanding, that naturally resident persons can be either juridical persons or natural persons, and in juridical there are two types. One is the domestic companies, entities, and then there are foreign entities. Second concept was taxable income. Decree law number 47 of 2022. We should remember this reference. Decree law number 47 of 2022, because this is the mother law of tax, which sometimes we call the decree in short, tax decree or tax decree law or tax law in short. It states that a resident person, which is a juridical person, legal entity, is subject to corporate tax on its taxable income derived from the UAE or from outside the UAE. So basically, worldwide income. So just to as a memory hook, any company that is set up in UAE, the entire income, the entire global income, worldwide income of that entity, which you incorporated or set up in UAE, it will be taxed in UAE. It doesn't matter where that income is coming from or where the income was earned. Secondly, the taxable income of a resident person, which is a natural person, is the income derived from the UAE or from outside the UAE. So the interesting point is that uh, if a natural person is a resident person, then the income from the UAE will by default be taxable in UAE. But what portion of income from outside the UAE will be taxable? Insofar as it relates to the business or business activities conducted by the natural person in UAE. This is a key point for you to remember. Please don't confuse this point. It is for natural persons, their UAE income is by default taxable. But what about their foreign income? So the example is that let's say you guys are natural persons. You started a business in UAE, and then you exported, for example, or the export of goods or export of services. So the customer is not sitting here in UAE, it is export income, but that will be taxable in UAE. But let's, for discussion sake, what you did was while you are a natural person, you're living in UAE, but you acquired either a business outside UAE or you did some sort of an arrangement with another person sitting outside UAE in USA or China, which gave rise to a permanent establishment, fixed place of business in the foreign country, then that income will not be taxable in UAE. Why? Because now the source of income will be seen as situated out of UAE. Because it becomes a permanent establishment, and if it becomes a permanent establishment, the income goes out of the scope of UAE for natural persons purely. This is not the case for juridical persons, by the way. Example, business activities likely to generate taxable income will include a manufacturing plant owned by an LLC, a camel farm owned by partnership. You please remember they've used the word partnership. So general partnership is seen as a legal person in UAE. A legal consultant business owned by sole proprietorship, an oil well owned by a public joint stock company, or property rental business owned by an LLC. All of these are certain examples. Any questions up till now? So we are moving to non-resident persons now. So non-resident person is a person who is not considered to be a resident person, and it meets the following conditions. That non-resident person, it has a permanent establishment in UAE. So that non-resident person, although it is a non-resident person, it's a foreign company maybe, but they have a branch in UAE, for example, or sometimes they might not even have a branch in UAE, but they have a fixed place of business in UAE. Even then, it will be taxed under Article 14. So, Article 14 of the mother law, the decree law, talks about permanent establishments. Second criteria derives UAE sourced income. So, in the last lecture, we had discussed a fine line of difference between income earned from a permanent establishment and then UAE sourced income. Can can anyone recall, Kalma, may I ask you, what is the difference between permanent establishment and UAE sourced income? Fine line of difference is there.
uh, Income play when there is a permanent establishment means they have the company here and they're
Company,
generating the no,
company.
they have the business here.
Business here. What shape that business could take? Branch
Yes, branch or office,
or an office or factory, any permanent place of business,
warehouse.
warehouse, all of those things could be permanent establishments. So a
So
non-resident company may be situated in India, which has any of these things in UAE, that will be seen as a permanent establishment in UAE of that non-resident person, that Indian company, right?
yes.
Then what would be UAE source income? What is the difference?
Um,
Can a non-resident person, someone from outside, a foreign entity, or an artist, or a concert
when they
singer?
come just for a one day for they can
Yeah,
generate income for an activity.
yes. Or even services can happen, right? Somebody sitting
Yes,
outside UAE could be
but they
providing
deliver the services here.
services online and all that. So that's the difference between UAE source income and permanent establishment. Third category, non-resident may also have a nexus in the UAE as specified in a decision issued by the cabinet at the suggestion of the minister. So in UAE, a non-resident is subject to corporate tax on taxable income attributable to permanent establishment, UAE source income, and third one was nexus. So in last lecture, I had given an example of nexus in UAE. Can somebody recall that? There's only one category which has been identified as nexus up till now. In black and white, it has been identified as nexus. There may be others, but what is the concept of nexus? Anybody can tell me the literal meaning of the word nexus?
Connections.
Nexus, connections, yes. So, and that example, that point that has been covered in the UAE law, especially in decisions, one example has been given. One particular thing has been identified as the nexus of a non-resident person, a building, basically. That I mentioned in the last session as well, but people are not responding. So I'm going to repeat this. Actually, nexus can be, broader than that. I gave an example of a virtual nexus. People sitting outside earning money from YouTube channel or Instagram channel in UAE, right? That could be a nexus. So that's a virtual nexus could be there. So a nexus is a connection, maybe an association is there, which is giving business leads to that person. Members are getting their business done. So that is also a series of connections. Uh, that's an example of nexus. At the date of writing, the cabinet decisions are yet to be published. So they were published actually later on. So more detail is available in those decisions. So at the end of today's course, I will share the relevant decisions, inshallah. So please, why we are in the second stage of second module of the corporate tax. So after completion of the course, I would share decisions. But some of you may not be practitioners as such, but it is a good idea to have at least the decisions should be there. Although at least you should study the decree law because it will at least set up your base. Non-residents are liable to UAE corporate tax on income earned through a UAE permanent establishment from source or from nexus. That was the summary, and an example has been given. A high-tech company formed in US, so it's a foreign company, which has established a branch in Dubai. So this is a permanent establishment of that non-resident person in UAE to employ staff to write code to be delivered to the US head office. So the programming is happening in UAE. Is likely to be a UAE permanent establishment. A UK company providing management services to its UAE subsidiary and receiving a fee for that service will derive UAE sourced income. So management services are being provided to a UAE subsidiary. So that would be subsidiary. Why it is UAE sourced income? Because subsidiary is a separate taxpayer. We need to remember taxation, corporate taxation happens in terms of entities. So if it is a subsidiary, that is a separate legal person. So UK company that is there, it is a different legal person. So if it is earning management fee from the UAE subsidiary, then that UK company does not directly have presence in UAE. It is earning money from another taxable person, separate legal person. So that is why it is UAE source income. So again, state source income, Article 13, we sometimes call it UAE source income also. So same thing, Article 13, we're going to look at it. UAE source income, in this section you'll explore. Let us have a look at it. Resident person. When the resident person, where it is derived from a resident person, then it becomes a UAE source income. So very interesting. So they have basically caught the bull by its horns from the other side, basically. So doesn't matter who is receiving the income. If it is being received from a resident person of UAE, then this income will become UAE sourced income. So a non-resident may earn something from a UAE resident. That income will be taxable in UAE. Why? Because it is a UAE sourced income. Second category, non-resident person, where some income is derived from a non-resident person and the income received has been paid or accrued in connection with and attributable to a permanent establishment of that non-resident person in UAE. Very interesting point. Uh, some insurance companies, mostly the insurance companies, and a lot of foreign banks also, they don't have a full-fledged LLC here in UAE, and they have been my clients also. That's why it's a first-hand experience. That's a very interesting angle. So I have a question for you. Let's say one insurance company, let's say LIC of India, that was my client. Similarly, Qatar Insurance branch was my client, and Iran Insurance branch was my client. Now, let's say this LIC of India, which only has a branch in UAE. LLC is not there. Full-fledged company is not formed. Only branch is operating in UAE. Okay, that's a practical question on which, I mean, actual advices have been given. So I'm going to ask you this question. This UAE branch of LIC of India, which is an insurance company, they have a client which is not even located in UAE. That's a very tricky scenario. The person is sitting in somewhere USA, non-resident person. Okay, that income, is it taxable in UAE in your view? Can somebody answer me there?
Yes.
Anybody?
Yes,
Okay, very good. So majority are saying yes. And why is that so?
because
Bec-
this non-resident
Because
person
branch
has a
is
branch,
Hmm,
permanent establishment in UAE.
in UAE. Perfect. So yes, so that is the whole point of it. Uh, uh, Income from a non-resident person will also be taxable if it can be attributed to a permanent establishment in UAE. Okay, a non-residence permanent establishment in UAE. Any confusions for any other person? Farjad and Absar and everyone, you guys are clear?
Sir, I have a question
Yes,
regarding this.
yes, please.
If the permanent establishment of that insurance company did
Mm-hmm.
not show the US based client in their books,
Hmm.
will it be taxable even then? Because the connection the client obtained by the permanent establishment based in UAE, they
Uh-huh.
can easily show that they did not get this client because of the UAE based branch,
Very good.
but Indian based company.
Yes. Okay. Very good. So a good question. Before I answer that, can I ask any other person to respond to this point? I mean, a very valid point raised by what's your name, my dear? Was it
Farzad.
Farjad? Okay, valid point raised by Farjad. This branch may decide to simply keep it off the books of UAE because that person is not here. It's somewhere in US. So anybody can comment on that?
But then, but then in this case, wouldn't the money still be received in the UAE? And that way it can be linked to a UAE-based income.
Hmm. Okay, that's again. See, okay, let us look at it from this angle, Farjad. Couple of things we need to understand and remember. First of all, nowadays in all the countries of the world, the tax laws that are being introduced are based on self-assessment regime. Am I right, Abbas? These are all
Yeah.
self-assessment regime laws, right? So
Yes.
what
Yes.
what you
Yes.
declare, the tax authority accepts, and the moment you click that button of filing the tax return, from a legal point of view, that tax return becomes an assessment order. If we talk in terms of Pakistan or India, so this is called self-assessment regime. That means, in a way, tax authority is saying that we trust you. So whatever you are telling us, we trust you. But by saying this, the tax authority is also saying that if you defraud, then please remember that this is you who has filed this tax return. It is a declaration that you are giving, that there is no fraud or hiding of taxable income in this return. So it's a self-assessment regime. So that means the person who is on purpose uh, hiding that income from the books is committing a tax fraud to begin with. Okay. And if at a later point it is discovered, it will be seen as tax evasion. It's not tax avoidance, it's straightforward tax evasion, which is a crime, financial crime. Okay. Now, so how would that person be afraid or be concerned about not bringing that client onto the books? As Abbas rightly said, there are many things in real life when you're actually transacting that business that come into play here. If the if the this transaction was originated through the UAE branch itself, if the seller, the representative or business development officer or whoever it is, it was clearly identified, there will be a name written of that person there and all that. Unless the company is hell bent on doing a tax fraud and not identifying even the names of the persons who had reached out. Even the contract was fraudulently prepared to be associated with a tax-free jurisdiction, Cayman Island or BVI or something. They will need to go into a lot of difficulty. Even the cash flow, right? Abbas very rightly said. Then the cash flow will also need to be diverted to another country. Effectively, it will need to stay entirely out of the books. and it becomes a nightmare for that branch to carry out this type of a fraud, because you have to entirely remove the trail of it. And if the trail is left, and God forbid tomorrow a tax audit opens up, and people as intelligent as you guys are there as tax auditors, don't you think you guys are going to start asking these questions? That, look, okay, fine, you showed me the profit and loss account, but I need to see other things as well. Let's see the record of the business development officers and how much business they have done. Let us have a benchmark, analytical procedures we will apply, how much business was generated by, lot of non-financial information, operational information you guys will be looking. So that is what happens in tax audit. And that is why, unless it is a very organized crime and very, heavily contemplated action, it will be very, it will be a higher risk for the company doing this type of an activity where they evade tax. So, this is the answer to your question. I hope that that is sufficient, Parjat.
Yes, sir, I got the point. Basically, I was thinking like that if a company that is based in India or Pakistan and has branches in different countries, so it could do a thing like that where the tax rate is lowest. That company can receive the amount in that country just to erode the tax base.
Absolutely.
That was the main concept.
Yeah. You are right. And it is quite possible that it may be happening. But we need to remember that this will still be considered as a tax fraud. And if later on it is discovered, the company will be subject to penal provisions. But yes, you are right. The company may be in a position to commit this type of a felony. You are right. So
Okay, sir, got it.
yeah. Okay, let's go to the next thing. Income from the sale of goods in the state. These are the categories. These are the categories of UAE source income. Income from the sale of goods in the state. Wherever the word state is, that means UAE. This gives rise to the question of where does a sale of goods take place. So, you could have the e-commerce platform in China, and you could be selling goods in UAE, right? So that's the example of sale of goods. If the goods are imported, then determining the place at which the title changes hands are fundamental. So, we always say sale happens upon, transfer of title in the property of the goods, right? Sale of Goods Act and Sale of Goods Act or other laws. So when does the title transfer? That will be a key thing. I mean, which place will the title transfer? So that will define whether it is a UAE source income or not. For example, if an Indian juridical person sells a tractor to an Indian juridical person for use in the UAE, then the resulting sales revenue is UAE sourced income. So, selling of the tractor to an Indian juridical person for use in the UAE, then it is still UAE sourced income. Income from the provision of services that are rendered or utilized or benefited from in the state. So, look how wide they have made the scope. Even benefited from in the state. Okay, rendered in the state makes sense, right? Utilized also, it also makes sense, right? But what about this word, benefited from in the state? The benefit is being received or arrived in the state. Even that would be considered as UAE source income. So, for example, if a UK accounting firm provides advisory services in the UAE to a UAE juridical person, then this will be UAE sourced income.
Sorry, just one. So if let's say the purest example, it's like a UK accounting firm giving advice to a UAE based company for a business that the company has in the US. Would that still fall under this?
Say again.
A UK advisory firm
Okay.
giving advice to a UAE based company for its business in the US, let's say.
It will still fall under UAE source income. Why? Because the person receiving the service is a UAE resident.
The UAE resident.
Yes.
Okay.
Even though you are right, the purpose
But
is different. Yes. Yes.
I
Someone.
have a question
Yes.
in the previous example, in
Okay.
the point number one. The both were the Indian juridical person. Then
Yes.
why it were UAE source income?
Good point. Let us read this last paragraph. I'm very glad that you were paying attention, Haya. Let us read this again. For example, if an Indian juridical person sells a tractor to whom? An Indian juridical person. Both persons are Indian juridical persons. But what about this part? Haya,
Utilized in
For
UAE.
use in the UAE. Yeah,
right?
so that means it would he or she would be no, sorry, it's a juridical person. So the company would be resident or PE would have been generated
No,
for the use in the UAE
use yes, exactly. The point is that the use
through the
is
PE.
uh, it yes, exactly. It could be a PE also.
How
I
he
mean,
how the company would be using the in the UAE.
exactly. How will it be using it if they are not present here? Chances are that this could be a reason.
Yeah.
Although there can be better examples to demonstrate
Can
that.
be a nexus also, right?
I wouldn't go that way yet because unfortunately, until today, the only decision on Nexus that has come that has highlighted UAE property as Nexus of a non-resident person, but it is open to interpretation. This matter may still be highlighted because that's a very logical thing to consider, especially from a virtual perspective. But until today, the nexus has been associated only with the property here. Other example of nexus we have to look at. Okay, like I told you, like being a member of an association, for example, in UAE, right? A non-resident person becomes a member of an association. Like I'll tell you very good example. One of my BNI chapter mates, BNI is basically a referral network market networking organization around the world. It operates in 70 countries. One of my chapter members, she participates in BNI meetings on the internet. Okay. And she's attending meetings in South Africa, UK, right, left and center around the world. She's attending those meetings, right? So that could be a very good example of a nexus. It's not because she's attending meetings on the internet. No, that's not the only reason. The interesting angle is that since BNI is a very wide network across the world, around 330,000 members are present in 70 countries. If that lady Rashta, who's my chapter mate, she gets income from that nexus. If that lady was sitting outside in some other country and she was attending BNI UAE meetings, for example, even in UAE we have 35 chapters, right? So 35 chapters she was reaching out to, and she started getting business from there. That would be a good example of nexus because that's a connection. That's part of being part of an association. Okay, Kalma?
So got it.
Okay. Third one is on contractor. Income from a contract insofar as it has been wholly or partly performed or benefited from in the state. So contract. So for example, if a KSA juridical person participates in a building construction project in Dubai Harbor, then the fees earned will be UAE sourced income. Okay. Contract. Whenever we talk about contract, immediately mind goes towards contracting companies, right? Construction contract companies, especially. So that's a good example given. Company was actually in Saudi Arabia, but they're participating in a building, construction of a building in UAE because they have some specialized expertise. I would wonder what those expertise would be, although because in UAE the real estate is huge. But just for discussion sake, if that is a scenario, then this income for that country will be for that company in KSA will be considered as UAE sourced income.
Sorry. So
Yeah.
like in that, in this case, then the KSA company would need to get a tax tax number here in the UAE as well, and then file as a KSA juridical person or a UAE person.
Okay. That angle of the question that you are asking is actually in previous experience probably you have dealt in VAT law where this matter comes in, right? But in corporate tax it's very different. It's very straight and simple, and you will need to get a tax registration number in UAE if you have earned that UAE source income. And yeah, so that's how it is. There is no withholding tax. There is no final tax regime here. So it's very simple. If a person from outside of UAE does any business in UAE, but I'll tell you another thing. There was another decision that came. It's a conflict between a decision and the decree law. This matter was raised actually when that decision came, that non-residents who are earning only UAE source income were allowed an exception from being registered in UAE. Are you aware of this, Abbas?
No, no,
This
no, no, I'm
decision.
not aware.
So yeah, so there is a decision which was introduced in I think 2000 early 2024, which raised a lot of debate and outcry, saying that on one side you're saying that in the decree law you're saying that UAE sourced income is taxable, which is understandable, fine. But then in a subsequent decision, you are saying that the non-residents who are earning only UAE sourced income are not required to register. Where does this fit in? How will you collect tax from them? Why? Because
Yeah,
the interesting fact is that in other countries, for example, in Saudi Arabia, where there is withholding tax, or in India or in Pakistan, where there is withholding tax, you can still earn you can still earn a reasonable amount of tax for when you deduct money from the payments to the non-resident. You know that, right? Tax
yeah, yeah,
deduction.
yeah,
But
yeah.
here in UAE, what are you going to do? Because there is 0% withholding tax rate in
Okay,
UAE.
exactly.
What I understood by more thinking on this angle was that if you read the article on withholding tax in the decree law, in the tax decree law, the wording is written very intelligently. It says that the rate of withholding tax in UAE is set at 0%, something like that. It is written like that. Why is it written like that? Because in future the wording may change. So it is a the withholding tax exists in UAE. So if somebody asks you, is there withholding tax in UAE? A general question. So a layman answer would be no, there is no withholding tax in
Hmm.
UAE. But a practitioner's answer would be yes, there is withholding tax in UAE, but at the rate of 0%,
So,
right? So
yeah.
rate has been defined here, but it's that it is 0%. So maybe tomorrow later on it may change.
But sorry. But just on this point, I mean, so in this point, coming back to the question raised by Farjad, that in this case the company is KSA based, and most likely the receipts will also be in KSA. And as you said, that the company does not need to get a TRN as well. So how would the UAE tax authority know that they have earned this income in the UAE then?
Yeah, so that's the whole thing I discussed just now, Abbas. If you really think about, that's what I said. The company will get receipts in KSA. It will not get receipts in UAE. So that is why
Yeah.
we this has been a matter of debate for the last 1 year, almost less than 1 year. That is the whole point. That there is a conflict existing between decree law and a subsequent decision where the non-residents were exempted or allowed an exception from registration, which created a conflict between the two sets of law, right? So in the decree law, obviously, it is not written clearly that a non-resident person should register. It is not written.
Yeah.
So
Yeah.
it was supposed to be clarified in a decision later on, but that decision, interestingly, allowed them not to register. So the result is that these non-residents who are earning UAE sourced income are going to go scot-free. No tax will be deducted from their payments. They will not register. It's a sweet tax-free income for them. That is the consequence of it. Okay.
But then, in truth, it should not be tax-free income.
It should not be. As per
Should
the
not be,
decree,
right?
as
Yeah,
per decree law, it should not be. But
yeah.
unfortunately, they will utilize that subsequent decision and refrain from getting themselves registered. So
Okay,
it allows them not to register. So that's an advantage basically given to them.
okay,
Maybe there are economic reasons behind it, but they have been kept out of the loop right now.
okay. Thank you.
Okay. Income from movable or immovable property in the state. So, for example, so this will be a UAE source income, but that is pretty easy to understand. By why? Because the property is located in UAE, so that by default becomes a UAE source income, right? Any points or concerns or questions on this point? Income from the disposal of shares or capital of a resident person. So, if there is any income from disposal of shares or capitals of a UAE company, for example, where you read the word resident person, think of it as a UAE company. Okay. So some non-resident had done an investment in, let's say, uh, Mubadala or some other listed company, right? Majid Al Futtaim, etc. Later on, that non-resident person disposed the shares of that company. Any gain, any income, that distributive share, anything that comes in, that will be taxable in UAE. It is still a foreign source income. An Italian resident investor sells stock in Diva, which is listed on the DFM, Dubai Financial Market. Then the profit from the stock disposal is UAE source income. But again, as we just discussed, the whatever we are reading is of no consequence, unfortunately. Why? Because that non-resident person is going to go free without having to pay any tax. Income from the use or right to use in the state. Or the grant of permission to use in the state any intellectual or intangible property. For example, so intellectual property, it could be anything. It could be a book, it could be a software. Intangible property, also, fine line of difference. So could be a brand, patent, etc. So, for example, if the owner of McDonald's logo enters into an agreement with a UAE company owning McDonald's UAE franchises for the use of the McDonald's brand, then the license fees from this agreement will be UAE source income. So the McDonald's logo is naturally owned by the McDonald's Corporation in USA. So the right of use income that the franchise fee that this UAE company will pay to the McDonald's headquarters, that will be the UAE source income for the McDonald's Corporation in US. Interest that meets the following condition. That is very interesting, guys. Loan is secured by movable or immovable property located in the UAE. Some non-resident person, a very interesting point, huh? Some non-resident person took a loan. Doesn't matter where that non-resident person is, doesn't even matter where that non-resident person took a loan from. But if that loan was secured against property located in UAE, then the interest income that the lender receives, that will be UAE source income. Borrower is a resident person. The person who took the loan is a resident person. Then again, the interest income will be UAE source income. Borrower is a government entity. So please remember that G is capital and E is capital. So we are talking about UAE local or federal government entities. So that is defined in the decree law. For example, interest on a loan extended by, say, Barclays in the UK to a UAE property development company, which is secured over the land and anticipated developed project is likely to be UAE sourced interest. So that interest on that loan will be UAE sourced, because the security, the collateral is the land that is located in UAE. Insurance angle, that is also very interesting. Insurance or reinsurance premiums when the insured asset is located in the UAE. So whoever is the insurance provider, whoever is the client, doesn't matter. But if the asset that is being insured is located in UAE, the premiums received by the insurer, they will be UAE sourced income. Insured person is a resident person. If it is a, if it is a natural person, for example, that is getting the insurance from some company situated in USA, because the person that is being insured is a resident person, the premiums will be UAE source income. Insured activity is conducted in the state, so that they have further broadened it, that the activity is conducted in the state. Now you can relate these points to the examples and discussions that we did on the previous insurance related scenario. For example, premium earned by a Japanese insurer from insuring risk associated with a UAE solar panel farm owned by a Qatari company will still be UAE sourced income. So, what are we securing here? A farm, solar farm that is located in UAE. Since the a person who is being insured is a UAE resident, it's the asset that is being insured is located in UAE. The entire revenue on the premium received by a Japanese insurer from the Qatari company, both the insurer and the person paying the money, both are outside UAE. That's a good example. But the only thing is that the asset being insured is located in UAE. So that revenue from of the Japanese insurer will be a UAE sourced income. Broadly, income source in the UAE, if the income comes, we've done that, so I'm not going to spend a lot of time here. Rental income paid by a UAE LLC. UAE LLC is paying some rent to a Qatari company for the right to use a rack, Ras Al Khaimah office building owned by that company will be UAE source income. So naturally, building is located in UAE. Article 24(1) applies. A resident person shall not take into account where the Article 24(1) applies. So I think this is the Article 24 that we were looking at. It's not written, but anyways, where was it? Yeah, applies. The resident person shall not take into account the following in determining its taxable income or corporate tax payable for a tax period. Let's see. Losses in any of its foreign permanent establishments. So I think it would be a good idea if we at least know the name of the Article 24.
Foreign permanent establishment exemptions.
Permanent establishment, right? Yeah.
Foreign
Foreign permanent establishment. So yeah, there is permanent
Foreign
establishment, and then there is
exemption, yeah.
we will talk about what is
Establishment is exemption.
what. So let's have a go through with this, because it's an interesting concept. Uh, what are foreign permanent establishment? Can you guys give me an example? Let's say you own a UAE company, okay, and you have a branch in, let's say, Oman. What would you call that branch? Is it your foreign permanent establishment?
Yes.
Yes, it is your foreign permanent establishment. And this Article 24 has an interesting exemption, which is optional, that it has given. We're going to look at that. So it's an optional exemption. The UAE company, your company, can either include the entire income of the Oman branch in your UAE corporate tax return. That's one option. and then claim the tax credits for the tax that you already paid in Oman. Okay, this method of tax relief is called tax credit method. And then another way of relief is that you can opt not to include the income of the Omani branch in your UAE books, and you can say that whatever happens in Oman stays in Oman. So no tax credit. Me?
Yes.
Okay, great. So going forward with the Article 24 foreign permanent establishment, where Article 24 applies, meaning foreign permanent establishment exemption, foreign PE exemption applies, resident person shall not take into account following in determining its taxable income or corporate tax payable in a tax period. What? Losses in any of the foreign permanent establishment, because you're taking the exemption, you're not including that the Omani things in your UAE books, right? So you will also not take the losses calculated as if the relevant foreign permanent establishment were a resident person under the decree law. Remember, shall not take into account. Okay. Positive income and associated expenditure in its foreign permanent establishment. So neither losses nor gains, they will stay out of the books. Any foreign tax credit, as I said earlier, whatever tax you had paid in Oman, it will stay in Oman. You will not be able to allowed to bring it into your corporate tax return of the UAE. So this is the exemption method. I want to stress on this thing. Some of you are already, mashallah, tax practitioners and you might already know. I'm going to repeat what you guys know. Some of you might not know. That's why I'm repeating. This is called a double tax relief. Okay. And which has been addressed in detail in Model Tax Convention of OECD as well. And this is now applied all over the world actually. So this double tax relief can take either of the two forms as rightly provided by Article 24. So that first form is uh, foreign permanent establishment, keeping the foreign permanent establishment outside the books, letting them deal directly. That can be provided in the domestic law. It can sometimes be provided in the treaty as well, double tax treaty as well. And the second approach is that including all the income in the books of UAE, but also at the same time allowing for a tax credit because you already paid some tax in Oman. Let's ask a strategy question here. Why? Because we are not just studying corporate tax law, we are learning how to apply it in real life also. So let me ask a question. Now you guys will need to use your heads. Why? Because it is not written here. When you are giving a corporate tax strategy to a client and you have these two options, what will make you consider either of the two approaches? I mean, how will you start thinking on these lines? Can somebody comment on that? What route should you take? Should you include the income of the?
Where-
Yes, go ahead.
in which minimum tax liability is calculated.
Can you
The
repeat?
tax liability which is minimum.
Ah, yes, okay,
The
good. That
option. The
very good.
option
Ah,
in which tax liability is minimum.
minimized. The option in which our tax liability is minimized. Anybody else wants to say anything? So generally speaking, guys, Haya has pointed out a very good general rule for making majority of tax decisions actually. So whatever choice you have, remember this, you need to build a scenario for that choice. Or see which scenario gives you better tax advantage. So first scenario would be prepare your tax return by including the incomes and expenses of Oman in the UAE books, in the UAE corporate tax return, and see what is the overall tax liability. And second scenario is keep those incomes and tax credits in Oman out of the books of UAE and then prepare out of the corporate tax return of the UAE and then prepare the return and then see what is the overall tax liability. Whichever gives you a better position, choose that option. That is called tax strategy, thinking on strategic lines. So very good answer, Haya. The consequences of an election being made are to be
Mr.
excluded.
Altaf,
Yes.
now once a company waives this exemption, like for one corporate tax year, and then next year again they have to opt for this exemption, or it is automatically there?
So, I as far as I mean, we can look at the article also, but as far as I can tell you, this is an irrevocable option. So you cannot pick and choose. This is Article 24, foreign permanent establishment. Let us go through this quickly. Can make an election to not take into account the income and associated expenditure. Nothing is written here whether this is an irrevocable option or not. Right? Can you see in the first clause? It is not. They shall not take into account the following in determining. So, going forward, under the second clause, it says what not to include, what not to do, right? Then again, uh, in the third clause also, it does not mention whether this is a revocable option or irrevocable option. Apparently, it is not written here for foreign permanent establishment. I think we may have a no, we don't. So I mean, what we let us go through this. Maybe they have mentioned here. Apparently, in the article, it is not written whether it is a revocable option or an irrevocable option. But I can, from if my memory serves me right, this is an irrevocable choice. Once you make the choice that you can include it in your tax return or keep it outside, then you cannot you know year on year pick and choose this option. So you have to make an election. The consequences of an election being made are to exclude from the personal duty taxable base the foreign permanent establishments, loss, income, expenditure, everything basically. For the purpose of Article 24(4), transfer of assets or liabilities between a resident person and foreign permanent establishment shall be treated as having taken place at market value. So basically, what they are saying in this clause 4, is that asset transfers will be as if it is happening between related parties. Okay, the transfer from UAE head office to foreign branch of the assets and liabilities are to occur at market value at the date of the transfer um, of determining the the resident person's taxable income. One more thing is that in the absence of Article 24(5) of the decree law, including words confirming that any gain arising to the head office on the transfer of asset liability is to be taxed to the head office, no such gain or loss should be taxed to the head office. It would be advisable to clarify this question with the FTA. So, Kalima, to answer you, to be quite honest, I want to park this question. Later on, you can also check with me. But as far as the decree law goes, the fact that it is an irrevocable or revocable option has not been mentioned here. Okay, we can look into it and we can find out if there is
And
a yeah.
and one more thing, if we opt from either of one option, if we go for tax credit or we offer exemption, we also need to consider in pursuant to BEPS Pillar 2. Either it's the total of it is of the minimum tax rate 15%. It
Well,
should not lie between below 15%.
very good question. Very good question. But I want someone to challenge this point raised by Haya. I think Abbas can do that. Abbas, would you like to comment on that?
I'm just thinking about this point just now that how and what impact. That took me some time to think about it.
Okay,
Yeah.
any other person? Can I give you guys a hint to challenge Haya's question?
I
Guys, we are talking
um
about a permanent establishment. BEPS Pillar 2 applies on what? Think about it. BEPS Pillar 2 applies on multinational enterprise, which is a group. And in a group, what happens? Do we consider branch as forming a group, or does it have to be a separate legal entity?
It has to be a legal entity because a branch would be with the company only, right?
But yeah, I mean, but I think
In terms of
that's one thing. But even if we consider the permanent establishment as a separate entity for that matter, Haya, you please correct my understanding. I may be wrong here in the BEPS Pillar 2 interpretation. Can a branch also be considered as a constituent entity?
I need to go through the definition for
Exactly.
that.
So
Constituent entity definition.
see, well, okay, let us assume let us simplify things. I am going to assume that the branch, although it is not a separate legal entity, it is an extension of the head office. But for just for discussion's sake, let us assume that it is allowed. Okay, it will be still considered under BEPS Pillar 2. Okay, let us assume that for a second, that it will be considered a constituent entity. That's the wording of the BEPS Pillar 2. It will be considered as a constituent entity located in another jurisdiction of the world, right? Even then, Haya or Abbas, what are the other things in BEPS Pillar 2? There is a huge criteria. What is that criteria? Why revenue threshold is there, na? What is the revenue threshold? Come on.
Yes, revenue threshold.
750
It's a
million, right?
loan of
750
750
million,
million
exactly. In order for BEPS Pillar 2 to be
euros.
invoked, the global consolidated revenue of the group has to be 750 million euros and above, right? And it has
Yes.
to be in more than one jurisdiction. So that is going to be a vital thing here, Haya. But I will tell you, hopefully in one of the next lessons or next sessions, we are going to discuss something which does not, which does not invoke BEPS Pillar 2 global minimum tax rules, but still the person will be subject to certain provisions of transfer pricing. Maybe it's a bit irrelevant, but still you should remember that if the local entity itself hits 200 million dirhams of revenue, then some of the transfer pricing requirements become very, very relevant here. But anyways, it was nothing to do with the rate. But as far as the 15%, which is the minimum tax rate, in order for that to become effective, the revenue will have to hit 750 million euros. Otherwise, we can forget about it. Okay, going forward,
Got it.
transfers from the UAE head office to the, okay, this we studied. But that was a good question. Guys, I want you to go to the BEPS Pillar 2 and specifically look for the concept of constituent entities, okay? And tell me this answer, whether a branch rather than a separate legal person will still be considered as a constituent entity. So that answer you guys need to tell me in the next session or over WhatsApp, okay? Permanent establishment, Article 14. In this section, you will learn the meaning of UAE permanent establishment, which is relevant. Okay, we just when determining whether non-resident has a UAE income, they are repeating a lot of things. Let us go through. The FTA commentary has confirmed that the definition of permanent establishment has been designed on the basis of the definition provided in Article 5 of OECD Model Tax Convention on Income and Capital, and the position adopted by the UAE under the multilateral instrument MLI to implement tax treaty related measures. So basically, the summary of this is that what the concept of permanent establishment, as it has been laid out in the UAE corporate tax decree law, it is on the same lines as OECD Model Tax Convention. This allows foreign persons to use the relevant commentary of Article 5 when assessing whether they have a permanent establishment or not. And I can, yeah, I mean, I'm sure some of you have gone through that. Very similar thing. It's a reflection of the things that has been mentioned in the OECD Model Tax Convention. And I mean, you read either of the documents, either the UAE Corporate Tax Law or directly Article 5 of the OECD Model Tax Convention, you will find exact same things over there. Non-resident person and a permanent establishment in the UAE. So which article was only for permanent establishment? Yeah, Article 14. Article 14. I remember now. Oops. Yeah. Quickly have a look at Article 14. So it's a quite a sizable article, let's put it that way. Yeah, there it is. So you can see, I mean, initially they in the Article 14 on permanent establishment, the law talks about what would be a permanent establishment. So there's the first clause of Article 14. It gives where it has a fixed or permanent place of business. This is the key point, guys. If you forget this point, you have forgotten the meaning of permanent establishment. This is the most important wordings that I can stress upon. Fixed or permanent place of business. Okay, that's the first thing. Anybody asks you tomorrow, what is permanent establishment? Without thinking twice, the answer should come. When there is a fixed or permanent place of business in a state, that's permanent establishment. Secondly, where a person has and habitually exercises an authority to conduct business or business activity in the state, right? The person has and habitually exercises. This is first condition, and this is the second condition. Habitually exercises an authority to conduct business. And another thing, where it has any other form of nexus. Please remember this. Even the word nexus has been included in the definition of what? Permanent establishment. Specified in a decision. Now, this decision came later on, which was on the nexus. So, for what else is there? Now they are giving, from the second clause of Article 14, then the examples start. A place of management where management control decisions are taken, branch, office, factory, workshop, land building, real property, installation or structure, exploration of renewable or non-renewable natural resources like a mine or a quarry or a oil well, for example, right? All of these. A mine or next में दे दिया they gave it in the next one. A mine or an oil and gas well, quarry, etc. अच्छा, building site, construction project, place of assembly or installation, etc. So all of these were like examples of permanent establishment. But then again, this article, when you read it in the decree law, you'll need to be patient. First, they gave the examples. Then in the very next clause, clause 3, they say something which confuses initially, but then it clarifies. Notwithstanding whatever has been said above, a fixed or permanent place shall not be considered permanent establishment of a non-resident person if it is used solely for any of the purposes. So in the clause 3, these are exceptions to the permanent establishment. They may look like at the outset like permanent establishment, but actually they are not. So what are those? Storing, displaying, delivery of goods or merchandise belonging to a person. So basically this is only storage or display of goods. Okay, storage or display. Keeping a stock of the goods or merchandise belonging to that person for the sole purposes of processing by another person. Temporary storage. Purchasing goods or merchandise or collecting information for non-resident person. This is something, if you remember, collecting information in our earlier modules, we read about rep office. Remember, guys? One of the types of licenses that we get in UAE, one example is rep office, representative office. So they only do collection of information or research on the market and all that. They don't do business. So conducting any other activity of prepare. Now these are the most important keywords for us to remember. When somebody asks us the question, are there certain specified exceptions to the permanent establishment rule? So if you cannot remember the above ones, and even if you remember these 3-4 wordings, at least you will remember. This is a memory hook, great memory hook for you. Where a person does any activities of preparatory or auxiliary nature. If that is the case, then that place in UAE will not be seen as a permanent establishment. Okay. This is something for us to remember. Conducting any combination of activities provided that the overall activity is of preparatory or auxiliary nature. Now, okay, first, so what happened in clause 2? They gave examples of permanent establishment. Clause 3, they gave exceptions to the general rule of permanent establishment. But when we go to the clause 4, again another very interesting thing comes in. Clause 3, which is the exception, shall not apply to a fixed or permanent place that is used or maintained by a non-resident person if the same non-resident person or its related party carries on business or business activity in the same place or at another place in the state where all of the conditions are met. Meaning they're saying that even there are exceptions to the exception rule. Okay. So we have to be careful while reading the fourth clause, which is exception to the exception rule, where the same place or other place constitutes a permanent establishment. So what they are saying is that you had a rep office, it was not doing any business, maybe collecting data or whatever, or you had only a storage and display facility, and but unfortunately in UAE you had another place which was doing business actually. So you had actually another place which met the criteria of permanent establishment. Then altogether it will be seen as permanent establishment. So that means that rep office will also become part of the overall permanent establishment outfit. Did you guys understand this point? Exception to the exception rule. Okay. The overall activity resulting from the
Yes.
combination of it. Now another thing. So this point I like to sometimes say, let's read through it. The overall activity resulting from the combination of activities carried out by the non-resident person or related party at the same place or at two places is not of a preparatory or auxiliary nature and together would form a cohesive business operation. To explain this, I sometimes use an analogy. What is that analogy? Think of boat and the paddles. Okay. Can you run a boat in water? I mean, not a mechanized boat, a simple wooden boat in water. If you don't have pedals, you cannot, right? You want to run the boat, you need pedals to row the boat, right? But your boat is in one place and pedals are in another place. Right now, boat will not run. But if you look at both together, then you do have a boat, then you can travel. That is the concept laid out here. Meaning you have two such places in UAE which in isolation looked separately do not form permanent establishment. But if you look at them all together, then they meet the criteria of becoming a permanent establishment. Then in that case, both places together will be seen as permanent establishment. Clear, guys? So this was basically the article. So what else is there? For the purpose, the person shall be considered as having and habitually exercising authority to conduct business in the state on behalf of non-resident person if any of the following conditions are met. Now remember, we are talking about that exercise of authority basically. It has a place and then habitually does business there. So what are those things? Person habitually concludes the contract on behalf of the non-resident person. Okay, the UAE person habitually concludes contracts. This could be a dependent agent scenario as well. Like I can tell you about myself that when I went to Oman on behalf of my employer AJMS, which was there, I was the only person in Muscat at that time. We did not have any office in Oman. I was just simply living out of a rented room, right? But I was doing business there on behalf of AJMS Oman. My time of stay was more than it met the criteria of being a resident, for example, right? So I was there for all the year effectively. Only few days I would come to UAE. So my permanent residence effectively became Oman, right? And I had the authority to conclude contracts on behalf of AJMS. As a matter of fact, another thing that is mentioned here, habitually negotiates contract that are concluded by the non-resident person without a need for material modification. So that was the scenario that I had. either I was concluding the contract myself, or it was only a formality that I would negotiate the deal, engagement letter, whatever it is, and I will just inform the CEO here in UAE that look, this is the deal I have negotiated. So if you have any feedback, or and it would usually 99% of the cases, there 99.9% of the cases it would not be changed. So without any material modification, the deals would be accepted. That again is an example of habitually concludes contracts. Okay. What else is there? So that was the example of a kind of a dependent agent. This is the example of a dependent agent usually operating so you can construe this example on UAE, that some person from USA or Pakistan or China may be a director or a shareholder or even any other person who's on the payroll of that company located in India or Pakistan or China or wherever, comes to UAE, starts doing business. He doesn't have an office, whatever it is, but he is concluding contracts. This will still give rise to a PE, and the nomenclature that we use is called dependent agent PE, dependent agent permanent establishment. I hope you guys are clear on my example of permanent, because this is a crucial concept. I would go to the extent of saying that the entire world of international taxation is moved maximum because of this permanent establishment doctrine. The model tax convention, actually, the history of this model tax convention by OECD, it actually triggered from the challenges created by permanent establishment. So this is such an important concept. Anyways, then I think the last area, Article 6 in the permanent establishment says the provisions of uh, paragraph 1, clause 1, paragraph B shall not apply where the person conducts a business or business activity in the state as an independent agent. Great point raised here. So remember, guys, what is the difference between a dependent agent and an independent agent? So like I am doing stuff on behalf of a company in Pakistan or India, for example, and I am getting paid as well, but I am not entirely dependent on them. Do you recall in our previous sessions when we've discussed the definition of business? If you remember, we mentioned that there are three criteria. It should be regularly, it should be on ongoing basis, and independent basis. Am I right? You guys remember the definition of business? That is exactly the same thing that is being
Yes.
repeated here. So the agent who's doing business independently means he is not dependent on that particular company to pay him. So he's not commercially, he's not financially dependent, he's not economically dependent, he's not legally dependent. So if that is the case, then that agent who's doing business on behalf of the person will not be deemed as a dependent agent. We need to remember this. What else is there? Uh, that's about it. Uh, where such presence constitutes a temporary exception. Okay, let us come back to our module. So this we have discussed in detail. Place of business, it has to be fixed basically. So what else is there? Conduct business or business, has the authority to conduct business or business activity. That's also we just discussed, concludes contracts and all that. Any other form of nexus in the UAE. Now, where it has any other form of nexus in the UAE specified in a decision, that will still be a permanent establishment. At the date of writing, no such decision has been published. Actually, the decision has been published now because this was written a bit, some time ago. You can see, can you see my screen here? This says Ministerial Decision number 83 of 2023 on natural person permanent establishment. Particularly, it will, I think, address. Okay, this was only on natural person permanent establishment, but I think there is a subsequent decision on nexus only. God, okay, let me check it. Okay. Anyways, I will give you the reference of this decision, but there is a decision actually which has identified that nexus will mean basically uh, a property owned by a natural person, non-resident natural person. At the date of writing, no decision came. What else is there? We note that the context of non-intellectual property regimes, the OECD Forum for Harmful Tax Practices requires substantial activities. Okay, so uh, such such that jurisdictions must require core income generating activities to be performed, and also to establish mechanisms to review compliance with this requirement. Why did this all come? Actually, it is a discussion of nexus. Where it has any other form of nexus in UAE is specified. At the date, no such decision has been published, but we believe it is most likely that the cabinet decision will adopt the definition from OECD tax report, which established the nexus by reference to the level of substantial activities. So yeah, I mean the literal meaning of the word nexus, a series of connection is there, but OECD's guidelines also address substantial activities. So in order for nexus to be established in UAE, there should be substantial level of activity. Only then, it will be seen as a nexus. Basic rule is that non-resident will have a UAE if it has a fixed place of business. Okay, repetition. So I'm going to go to the next part. Still being repeated, fixed or permanent place of business. This we just read actually in Article 14 in detail, but still let's do a review. A place of management where management and commercial decisions that are necessary for the conduct of the business are in substance made. So place of management and where commercial decisions, etc. Second, branch such as Abu Dhabi based center for a Luxembourg company. Fine. Branch, I think we already know the meaning of. An office such as 2000 square feet rented in Index Tower in DIFC. Okay, uh, it can be an office premises. A factory can be there. A workshop as a place where motor cars are repaired. Uh, Land, building, other real property. Installation or structure for the exploration of renewable, non-renewable resources. Mine, oil or gas well, quarry, etc. Extraction for the natural resources that the non-resident person is controlling. That can also be a permanent establishment. OECD commentary confirms that the term any other place of extraction of natural resources should be interpreted broadly. It includes, for example, all places of extraction of hydrocarbon, whether on or offshore. So even offshore will be considered as permanent establishment, like in the middle of the sea. It's anticipated that UAE would adopt a similar interpretation. Building site, construction project, place of assembly, etc. Did I mention uh, you know one case that happened in India, which was Formula One, which was headquartered in UK, and they had an agreement, I think joint venture agreement with a corporation in India, where they were running a circuit in I think Delhi, and that UK corporation was issued a tax demand notice by the Revenue Authority. They contested it in the court, but the High Court decided in favor of the tax authority, saying that although that UK entity does not have even a branch registered in India, the fact that this Formula One racing happens on a track which is a fixed place of business, that is why the income that the UK company earns, that income is basically uh, a permanent it arises from this permanent establishment, which is a fixed place of business. So that's a famous case in for which set the pace for permanent establishments, and it happened in India. When determining whether activities are connected, the OECD commentary confirms that it will depend on the facts and circumstances of each case. So there are factors that may especially be relevant for the purposes, including the following 4 factors: whether the contracts covering different activities were concluded with the same person or related persons, whether the conclusions of additional contracts with a person is a logical consequence of a previous contract. So that's a continuation of business. Whether the activities would have been covered by a single contract, absent tax planning considerations, whether a nature of the work involved under the different contracts is the same or similar. So, this is again what we are looking at. It was a discussion on fixed or permanent place in the UAE. So all of these criteria will need to be brought into picture. This Article 14, Clause 3 we read, which is the Clause 2 was examples of permanent establishment. Clause 3 was exceptions to those examples, which we had read that okay, only storage display will not become permanent establishment, or keeping of stock of goods for processing by another person, or most important, if you remember, I had highlighted that if the activities are of preparatory or auxiliary nature, then it does not constitute a permanent establishment. But even more important was the next part of it, which I don't know if they have given, but it was exception to the exception rule, where the example of boat and pedals had come. So yeah, I think they have given. So Article 14.4, this is the exception to the exception rule basically. 14.3 shall not apply to fixed or permanent place that is used or maintained by a non-resident person if the same non-resident person or related party carries on a business or business activity in the same place or at another place in the UAE where all the conditions are met. So the 2 conditions were identified where the same place or that other place is already a permanent establishment. And the second was the overall activity resulting from the combination of the activities carried on. This is the boat and pedal rule, carried out by the non-resident person and its related party at the same place or 2 different places. Together, it will no longer be preparatory or auxiliary nature. Applicability of the tests exempting certain fact patterns from giving rise to permanent establishment is inapplicable where the same or 2 or more other places will used by the related parties are PEs. If there is already a PE, then we can forget about the rest of the places, rep office, whatever it is, it will be a PE, permanent establishment, if there is already an existing PE in UAE. This also we had gone through. So, for the purpose of Article 14, Clause 1b, a person shall be considered as having and habitually exercising. I'm going to skip through this. This we have already discussed. This was dependent agent PE. Then conducts a business in UAE as an independent agent and acts for the non-resident person in the ordinary course of that business or business activity, unless the person acts exclusively or almost exclusively on behalf of the non-resident person. So yeah, it's an example of most usually it is an example of companies who are acting on behalf of a non-resident person. Even a company can be a dependent agent. Okay, if it is exclusively acting on behalf of the non-resident person. OECD commentary confirms that an independent agent will typically be responsible for his principal for the results of his work, but not subject to significant control with respect to the manner in which that work is carried out. So that's the indicator of an independent agent. He will not be in control of the manner in which that work is carried out. He will not be subject to detailed instructions from the principal as to the conduct of the work. The fact that the principal is relying on the special skill and knowledge of the agent is an indication of independence. So a PE does not normally arise when the person negotiating the contracts is an independent agent acting in the ordinary course of his agency business. So there's something called an agency business. So if a person is already running an agency business, then PE will not rise. Give me a second, guys. Okay, so continuing with our discussion, Article 14, paragraph 7. For the purpose of Article 14, paragraph 3, the minister may specify conditions in which. So the decision that we were looking at, Cabinet Decision number 83, I think, or ministerial decision was it? That decision came later on. So temporary and exceptional situation where such presence is a consequence of a temporary and exceptional situation, then it will not give rise to a UAE permanent establishment. That's the first thing, temporary and exceptional situation. Employee of non-resident person, where the natural person is employed by a non-resident person and all the following conditions are met, activities being conducted in the UAE by the natural person are not part of the core income generating activities of the non-resident person. It is not SIGA. The non-resident person does not derive UAE source income. And another condition that is there is, although the dependent agent is there, but the first of all, the activities are not SIGA, which is core income generating activities, and secondly, not even UAE source income exists. If that is the case, then the PE will not arise. The mother law, decree law 47, establishes a power in the minister to determine when a PE does not arise by virtue of a temporary and exceptional residence, or when the natural person is employed by the non-resident and none of the person's activities are SIGA and USO's income has also not arisen. So minister can finally give a final decision. So yeah, they did mention this ministerial decision 83 that I had shown you. Invoking this power, MD 83 on determination of the conditions came under which the presence of natural person in the state would not create a permanent establishment. We need to remember that this was a time when I think COVID was almost subsiding. Basically, it had subsided, and one of the things was that people were they had experienced in those days during the pandemic that they were stuck. And because of being stuck in a country, especially from a dependent agent perspective, there was a risk of permanent establishment arising out of that elongated stay. So that clarity was also highlighted in this ministerial decision, that it has to be, the presence has to be for the purpose of business, first of all, or at least UA source income should be there. So anyways, now we are coming to another very interesting angle. There is an article on investment managers exemption. So soon we are going to look at this. You will examine the meaning of investment manager exemption, which is an important matter for the UAE funds manager. Now we need to remember UAE, particularly Dubai. This is the financial hub of the MENA region, and also at a global scale also. This is one of the most desired financial investment destination because of their relaxed laws. So naturally, in places like DIFC, there are, or ADGM, even in mainland, there are so many investment managers, investment companies that are located out here. Now, and they are handling the funds on behalf of non-resident persons. So I'm going to ask you this question to think out of box and tell me that let's say tomorrow some wealth manager goes to an ultra high net worth individual sitting in US and he tells or advises or proposes to the person that how do you feel about investing in UAE or investing through our UAE company? We can, give you a lot of advantage. What would be the concerns that the US ultra high net worth individual would have, especially from the tax perspective? Can somebody comment on that? Please remember, giving you a hint, we have just read the Article 14, which is on permanent establishments. Abbas, you want
That
to?
if he
I
Yeah,
takes
think you.
advices from him,
yeah,
maybe
go
he
ahead.
becomes his agent.
Can you repeat that, Haya?
If he take advice or if he act or if he give business to that person, maybe he becomes his agent.
What about you,
I
Abbas?
I think for the person, he would be considering that if he's investing through the company based in the UAE, would it become a PE for that person in the US, and
Both,
then
yes, both of correct.
would he be taxed in the US as well as the UAE as well?
Both of you are
Because on his
absolutely
income.
right, and Abbas has raised a very good point actually. So additional points for Abbas that this could even trigger double taxation, right, Abbas?
Yeah, exactly.
So, absolutely. So these are the concerns that will come into play. That is why UAE corporate tax law became very lenient, so that the UAE, particularly Dubai, they may retain their image and branding in the world as the financial center hub of the world. So what they did was they simply exempted that investment manager, so it became flow through taxation. We're going to read through this now. Okay. For the purposes of clause 6 of Article 14, an investment manager, also known as a person who provides brokerage or investment management services that are subject to the regulatory oversight of the competent authority in the UAE, is considered an independent agent. And you know what will happen when that investment manager becomes an independent agent? What will happen?
There will not be a PE.
There will not be a permanent establishment concluded. Kalima, when will be a permanent establishment concluded in case of an investment manager?
If he is a dependent agent.
So that means there has to be some criteria, right? Some conditions must be met so that the independent status stays intact, right? That is, see, guys, what we are doing is not some very miniature, how do you say, trivial level discussions. What you guys are learning right now is the corporate tax strategy that we will be advising to clients. So we have to think on our toes and we have to think ahead. So when we talk about this, then we have to know about these conditions as well. Independent agent, uh, when that investment manager acts on behalf of a non-resident person, he must remain an independent agent. He must meet those criteria so that those investors, those high net worth investors, they will be quite happy while placing their monies in the hands of that investment manager, because there is no PE being formed. And if PE does not form, then the money will probably at best will stay UAE sourced income, and we know what happens to UAE sourced income, right? The non-resident does not even need to register for corporate tax. Where all of the following conditions. So in order for ensuring that the agent is independent agent, these conditions need to be met. Number one, investment manager is engaged in the business of providing investment management and brokerage services. How will this be evidenced, guys? How will this be evidenced? Come on, easy question. Trade
They will
license,
have a
right?
license for it.
Simple answer. Trade license. They should have a trade license of this investment management. And the investment manager is subject to the regulatory oversight of the competent authority. Which would be that competent authority? Can somebody give me an example? I have always stressed on two names, two financial free zones.
DIFC and ADGF.
Okay, can somebody improve this answer? You're 50% right. But DIFC and ADGM are not authorities. They are free zones.
Department of Economic Development.
Wrong. For DIFC and ADGM, for both financial free zones, there are two authorities which I have been.
Dubai Dubai Financial Market and Abu Dhabi Financial Market.
No, these are financial
Nasdaq,
markets,
Dubai.
not authorities. You guys have forgotten this. That's the problem. You guys should
That's
remember the.
DFSA, I think.
Yes,
There's one.
correct. Good. Abbas, you never disappoint. DFSA, Dubai Financial Services Authority. This authority oversees which free zone?
DFC.
DIFC. And then there's another authority which oversees ADGM Farjad. FSRA. Financial Services Regulatory Authority. That is the mother of ADGM. The mother of DIFC is what? DFSA, Dubai Financial Services Authority. These, at least you should remember these two authority names. And answer of Kalma was also right, so I can give her marks as well, because DED itself is an authority actually. So the Department of Economic Development, but DED is a regulator actually. So I take my points given to Kalma back. So DED is the regulator. The authority in mainland will be different. It may even be central bank. Okay. So anyways, the transactions are carried out. So there should be regulatory oversight, guys. Next point, transactions are carried out in the ordinary course of investment management business. Fine. It should not be a extraordinary transaction. The investment manager acts in relation to the transactions in an independent capacity. We saw what was the guideline of OECD in terms of independent capacity. Can somebody recall what we read? When would when would the conduct of business be seen as independent? When that agent does not have control on the manner of business. The principal has that control. Remember this point? That is an indication of independent capacity. So, the person who's representing the principal in UAE, he can only represent, but he cannot like really control that business. So that's something we should remember. The investment manager transacts on an arm's length basis with the non-resident person. Investment manager acts on. So this, which article is the one that addresses arm's length basis in corporate tax decree law? Can somebody remember? Article, famous article. We should remember this article. Article 34. Okay, 34 is the most important article. This apparently this one small article, Article 34. Do you know what has been the repercussion of this article? Not only in UAE but around the world, this type of an article. The entire 150 pages long transfer pricing guidelines were issued because of these few lines. Arm's length principle. The entire doctrine of transfer pricing rests on arm's length principle. The OECD itself has issued huge, I don't know how long, 600-700 pages or more long transfer pricing guidelines in OECD. Okay, so arm's length article in decree law is Article 34, which is a huge area in corporate taxation, and actually the majority of litigation conflicts for multinational enterprises between governments, they happen because of transfer pricing, not because of other stuff, but transfer pricing. And it is a very, very expensive affair when you have to engage lawyers to challenge the revenue authorities. So anyways, the investment manager transacts on an arm's length basis with the non-resident person and receives due compensation for the provision of service. Investment manager is not the non-resident person's representative in the state. So cannot be a representative in the state in relation to any other income or transaction that is subject to corporate tax for the same tax period. So that investment manager should only be restricted to doing investment management for that non-resident person. If he enters into something else, maybe into a partnership or conducting any other business, sale of goods or whatever, then this independence will go away and this exemption will not be available. Any other conditions as may be prescribed by a decision. So there was a decision actually issued on this. Investment manager is taken to be an independent agent, activities which of which do not give rise to permanent establishment. So let me go to the next part. So what are transactions? For the purpose of Article 15, this Article 15, I think this is for investment managers exemption. Transactions occur in any of the following three circumstances: transactions in commodity, real property, bonds, shares, derivatives, etc. Transactions of buying or selling any foreign currency or placement of funds. And the third category is such other transactions permissible to be carried out by the investment manager on behalf of the natural person under the legislation. So three categories, okay. The provision lists the nature of the underlying transactions which fall within the transactions authorized from an investment manager to enter into or now I want to quickly address something to you guys. You see this third point, such other transactions which are permissible to be carried out by the investment manager on behalf of the non-resident person under the what? Applicable legislation of the UAE, right? So just to let you know, guys, so let me see if I can quickly take this out for you guys. DFSA. There you go. So this is an article that I had already written, which has a lot of uh, research involved in it. So I'm gonna put this on the WhatsApp so that you guys can refer to it later on in your own time. It contains a reference to different types of activities that are allowed in Dubai Financial Services Authority. So you can, take a quick reference. Otherwise, you need a larger reference. Then you have to go to the website of the DIFC, and you can see. But this is a kind of a summary of different categories. These are the licenses of the categories that are issued to banking and financial institutions. Okay, so you can, if you want a quick reference, you can always go here and look at the research. So anyways, so the key point here is this is going out of the tax law and into the UAE legislation. And what I just shared with you, that is a reference to that legislation. So what are the things that the investment manager, for example, can perform? So those activities may not be the first two types which have been mentioned up there. They may be beyond, additional activities as well. The provision lists the nature of the underlying transactions which fall within the transactions authorized for an investment manager. So that was the list is narrow when compared with the list published by HMRC, His Majesty's Revenue. I keep forgetting the C Commission. I think
Customs.
Her Majesty's Revenues and Customs in the UK. The approved list of investment transactions includes, but is not limited to, shares, stock, commercial paper, warranties, etc. So quite a few activities have been allowed to be carried out by investment managers. Very detailed, currency swaps, hedge, derivatives, etc., etc. Further, in the UK, transactions in rights under a life insurance policy are also included. So even that is that. So what we are studying right now is what would constitute a transaction when in the context of investment manager. So what we saw that almost all types of financial services transactions, whether they relate to currency or commodity or real property or even real estate investment trust, all of those will be covered. And just for taking back with us for quick memory purposes, in UK, HMRC has even a larger definition of transactions. Example, a licensed ADGM investment manager provides advice and assistance to a Cayman fund in its purchase of a London office building. So what are we talking about? An ADGM investment manager, Abu Dhabi Global Market Investment Manager, provides advice and assistance to a Cayman fund in purchase of London office building, and then the building's subsequent disposal. A licensed DIFC investment manager provides advice and assistance to Luxembourg fund in its purchase and later disposal of the derivatives. So this is derivatives. This is purchase of an office building. These are all examples of transactions that that would hold well in the context of an investment manager's business. So now we're coming to, oh God, this is this is the heart of the corporate tax law. Let me tell you something, guys. Just for you to remember, I should take you to the corporate tax law itself and give you a broad, only from the table of contents perspective. This is corporate tax decree law. Okay. So in the decree law, when we started off, okay, fine, initially it was definitions, then scope was there. How does the corporate tax levy, right? Corporate tax rate was identified. And then in chapter 3, from article 4 until article 10, all of this what we went through in our previous session also was on exempt person. So if you really look at the infrastructure, the logical architecture of this law, it starts from specific exemptions. So by default it says law is applicable to everyone, all the resident and those non-residents which are subject to corporate tax. But these we will this is the first question we are going to ask. Are you part of any of those persons which have been identified in Article 4 and detailed in the subsequent articles 5, 6, 7, 8, 9, 10? If you are, then you go out straightforward, you go out of the ambit of corporate tax, except for, certain other conditions that we studied there in the previously. So once that stage is over, so this you could say person level taxation. So if please hear me out well, what I'm trying to say here. So when we start doing an impact assessment for corporate tax, the first stage is person level assessment or person level impact assessment. So we look at the type of person first. We don't directly jump into profit and loss account at income levels. We don't. First thing, look at the person. If that person has a specific exemption, we conclude. If it doesn't have a specific exemption, that's when next portion comes in, which relates to the residential status and tax base, etc., etc., etc. And after going through that residential status, tax base, unincorporated partnership, all of this what we studied, then we go into the income level. So it's a quite a later stage. Actually, 60-70% of assessment is already done when you reach income statement. That's a key point for us to remember. When we do corporate tax impact assessment, first 60% will be on all of this, getting to know what type of a person that is, whether there are permanent establishments, is it a group, is there common control, your state source income, all of this we are going to look at. After, if this person is falling under the qualifying free zone person regime, this is covered in the free zone person chapter, which is article two sections only, article 18 and 19. So 19, if you remember, it was election to be subject to normal tax regime. Once we have gone through all of that, only then we come to the income level area, which starts from article 20. So if you really look at article 20, this is the first article which is detailed as well, which talks about how do we determine the taxable income. Then immediately the decree law starts talking about certain reliefs, etc. One relief it has addressed, then goes to the exempt income. There are certain income level considerations that certain incomes have been exempted, and then again some discussion on reliefs is there. After that, then we go to the deduction, that what are the allowable deductions. Now going like from Article 20, another basically the next milestone of the journey starts from Article 20, and it goes all the way to deductions and then later on transactions with related party. So transaction level assessment basically starts from Article 20. Before that, it's all personal level assessment. Coming back. So having worked out the rules of determining the income earned by a non-resident is taxable in UAE and obligation. Next step is to calculate the taxable income. So what are the different rules? Taxable income for each taxable person shall be determined separately on the basis of adequate standalone financial statements. Now, keyword here is standalone financial statements. So one legal person, one company uh, is seen separately in UAE corporate tax, unless you go for forming of a tax group, which we will study later. So we must remember multiple companies are there in the group. We have to look at each of those companies separately. And as a matter of fact, as tax advisors, when we are looking at those companies, we even go to the extent of evaluating whether it is worthwhile to form a tax group or not. Again, what Hayat said, which was a very good thing to say, was that these strategy decisions are usually based on the monetary outcomes, but monetary is not the only basis. Some qualitative aspects can also come into play here, which is, for example, the biggest is compliance exposure or compliance hassle. Standalone financial statement need to be prepared for financial reporting. There is a ministerial decision 114. This is a key decision that elaborates Article 20 basically. Article 4 of the ministerial decision number 114 on accounting standards and methods for the purposes of Federal Decree Law number 47. It clearly identifies that IFRS will be meant when the word accounting standards is read. So so basically, what does that tell us? Let's say you have a client which is preparing financial statements under US GAAP, then what will you need to do then if you're filing tax return in UAE?
Also need to prepare, convert them to IFRS now.
Yes, there will be a US GAAP IFRS reconciliation performed, and it will be converted to IFRS. The financial statement will be converted and then return will be filed. Company shall apply the international accounting standards. Okay, what else? The starting point for the calculating of taxable person's taxable income is the person's financial statements. Yes, and I think I am afraid Haya and Abbas will be able to quickly answer this. Which is the note practitioners love to look at, or the what part of the financial statement the practitioner go immediately when they start doing? Don't answer Haya and Abbas. Let others answer this question. You are doing an impact assessment. You've been provided financial statements by the client. Kalima, you don't answer. Let me ask Farjad this question, because I think Kalima has also worked with me, so she might also quickly answer this. So let me ask other people. Momin, are you there?
Business activities, sir.
Yeah. So no, which note would that be? Shall we go into the income statement immediately or somewhere else? You're looking at audited financial statements of an entity. What is the first place that you're going to start reviewing? Most important.
In income statement, but his company has declared as a accounting profit.
Momin, are you there? Can you hear me? Okay, Momin is not there apparently. Okay, Haya or Abbas, you guys can answer.
or the legal
Note 1.
structures.
I think note 1 and note
Note
2.
note 1.
Yeah.
Absolutely, yes. So my assessment was right. You guys know how we will start off with the assessment. Yes, the first point that we are going to look at in the financial statement is actually usually note 1. And why do we look at note 1? Can somebody answer that?
Because it states the gap used to be
And no,
prepared.
yeah. Go ahead, Haya.
Also about the
The business
incorporation,
activity, how is it incorporated?
and
Exactly.
if there's any
Incorporation, business
subsidiaries for
activity,
the
and the standards
Yeah,
used.
absolutely. Very good. Very good. Yes, you guys are all right. Usually note 1 and sometimes another note, maybe a next note. It identifies, first of all, guys, if it is a group, then it will identify how many subsidiaries are there. If it is, where is the place of incorporation of that entity or entities, right? What business they are in. All the relevant person level taxation, person level assessment of the corporate tax will start from this note actually. So based on that, and as a matter of fact, okay, fine. You got to understand that this is an entity, the or multiple entities in the group. We have identified these are the different entities, etc., etc. This is the business that they are in. Uh, we are still sticking at the personal level. Is there any other note that you would want to look at that time? I mean, everything is relevant, but what else are you going to look at later on?
The compliant jurisdiction, the compliances
Yeah, jurisdiction
in
we are going to
with
look at. There will usually be a related party transaction note mentioned there, etc. So yes, I mean that's how it will all start. Let's
yes.
go to the rule 2. Taxable income for a tax period shall be accounting income. So yeah, I mean that's I think we start off from profit before tax in the income statement, right? Which is the accounting net profit or loss for the relevant tax period as per the financial statements, and to the extent applicable, adjust according to circumstances. Now there are a number of things that have been highlighted by Article 20. Very important article, because this is the key article which takes us into phase 2 of the impact assessment, which is transactional level details, right? So unrealized gains or losses, there are rules on that. Taxpayer may elect to be taxed on all gains and losses on a realized basis, or to be taxed on unrealized gains and losses on revenue account. I think it will be better that I show it to you here. Let's do this. So this is Article 20, General Rules for Determining the Taxable Income. So in the one, I mean, fine, it is says taxable income of each taxable person shall be determined separately on the basis of adequate standalone financial statements in line with the accounting standards. But after that, it identifies, for example, unrealized gains or losses, which are covered in the next, clause 3 of this article. This is a key point: unrealized gains and losses. Exempt income. So what are we going to do with exempt income? In the adjustments column of the return, we are going to take the effect of exempt income out. Reliefs. If there are relief related matters we are going to address. Let's just, I don't want to elaborate more, but let us just say, where if there is any relief related matter, we are going to adjust. For example, you will see at a later stage that sometimes between group companies, if there is assets transfers, we don't book the gain, because that transfer is within a qualifying group. So we will remove the effect of the gain from the profit in the adjustment column. Deductions. There may be certain deductions that may be allowed but not reflecting in the income statement, that we can do, or certain deductions we have claimed but they are not allowed. An example is entertainment expense. We are going to come across that later. Transactions with related parties or connected persons. Now, which article was that? Can you guys remember? I just told you, right? Arm's length
Article
transaction.
34.
Article 34. So that Article 34 and the next articles, Article 35, which is for related parties. If you look at it, this is Article 35, and connected person is the very next article, Article 36. Okay, so 35 and 36. So these articles will become relevant here, and God forbid, if you had violated any arm's length principle, then the authority may say that, you have reduced your taxable income. So you have to book an adjustment for transfer pricing. That is, so that we will need to book in the adjustment column and increase our taxable income. Those, if there is a tax loss relief, like in UAE corporate tax, you can carry forward tax loss up to infinity. So if you are deducting that carried forward tax loss, that you will do. Any incentive or special relief for a qualifying business activity, so those you can take. So all of these adjustments we will need to perform. But I just want to take you to the clause 3, which is on unrealized gains and losses. So this you need to carefully understand and remember. Okay, so unrealized, can somebody give me an example of unrealized gains and losses in that come in the financial statements?
IFRS 9 based
Exchange
gain and
gain,
loss.
exchange losses.
Let Mujaddid speak. Mujaddid, you were saying, yeah.
Farzad here.
Farjad, yes,
Uh,
sorry.
IFRS 9 based gain and loss, which could be, if we disposed of the investment, it could be a realized gain, and at the
Yes,
year end we mark to market the a gain that is unrealized.
very good,
Both
very
are
good.
representing in either a PNL or OCI based on the election you have made on the short-term investments.
Absolutely correct. Yeah, any other example? What about investment property?
Yeah, I have on the IS 40 as well.
IS 40 as
Uh,
well. Yeah, yes.
Even IS 16 as well, I think.
IS 16
Yeah,
as well.
16 as well.
Yeah, that can be like in old days it was called revaluation surplus, right? So anyways,
Yes.
uh, the point is there can be different types of gains that can come into play, right? Some of those gains become part of the revenue for the year, okay, profit for the year. Some of them, uh, go into the other comprehensive income. So we are going to look at that, but let's read this properly. The taxpayer may elect to take into account gain and losses on a realization basis. So it says that this sentence, this part, if you read it carefully, this is an option, right? This is an option what we are going to look at in the next two clauses. Then what is the default treatment? This is optional. What is default treatment?
That you exclude them then.
No, exclusion means you are reducing your profit. If it is gains, if you're excluding them, this is reduction in profit. The default treatment is that we will follow the accrual basis. It's as simple as that. What is your name? Farjad, I think, was mentioning, right? So he was saying
Yes,
that
sir.
there can be.
Cash basis except
I couldn't hear you, Haya. Haya, can you repeat, please?
I said a cash basis.
Yeah,
It says like financial statements are prepared on accrual basis and may elect to take into account gains and losses
on
on
real, correct.
realization
Yes,
basis.
exactly. So the
Maybe it says cash. Yeah.
no, you're right, but that's the cash basis
Go
is
ahead.
only cash basis
Yeah.
is only the optional treatment. Okay, may elect on realization basis means cash
Yes.
basis, but the default treatment is accrual basis. What Farjad had mentioned was basically the what do you call uh, uh, the accrual basis, meaning, for example, mark to market adjustment. Sorry, I got a call, so I was distracted. But the point is that this can be on when you do a mark to market adjustment, cash is not coming in, right?
Yes,
No.
exactly.
Yes.
So if it does not come in, what does that mean? It means that uh, if you really look at the unrealized gains, it is inflating your profit for the year. It is in line with IFRS, but from a cash perspective, this much amount of cash has not come. Correct. So that's a key point for us to remember. If we follow this default treatment, that what will be the impact on taxpayer?
You would be including the unrealized gains then.
He will have to include unrealized gains in its profit. That will mean he will have to pay a higher amount of tax if he follows the default treatment. So don't you think that that realization basis, especially for those industries such as insurance, which are because insurance companies have to invest their money into investments, right? Biggest portion of their, other than premium, a very significant portion of their income or revenue is those mark to market gains that they book in their books. So if they continue on that default treatment, they will be paying a larger amount of corporate tax as compared to realization basis. If they did it on realization basis, if in a year their mark to market adjustments are quite big, all of them will go away. You will need to take it out if you're following the realization basis. Don't you agree, Abbas?
Yes.
So
Yes.
this is a strategy point for us to remember. But let me tell you, we have to be very careful
I have
because, yeah,
a question. Don't we add back unrealized gains and losses while
that
calculating
that happens,
taxable income?
probably that happens in Pakistan or India or some other jurisdictions. In UAE, the default treatment
Yes.
is IFRS.
Yeah.
Whatever IFRS accepts as period cost or
Okay.
period gain or revenue, that stays. So that is the default treatment. Okay. The optional treatment is that
Okay.
this is a
Okay.
leeway, this is a leverage, this is a facilitation given by UAE corporate tax law to entities that look, if it helps you to manage your cash flow better, then you can choose realization basis. Okay, clear?
Okay. Yeah. Clear.
But if you're okay, now we have to understand what two different methods or modes are available for realization basis. First mode is then all assets and liabilities that are subject to fair value or impairment accounting under the applicable accounting standard. So if you are choosing realization basis, then one choice will be all assets and liabilities that are subject to fair value or impairment accounting. Clear? Second mode will be all assets and liabilities held on capital account at the end of the tax period. When we use the word capital account, held on capital account, do you know what that means? It means that those assets and liabilities which are of capital nature, while taking into account any unrealized gains or losses that arises in connection with assets and liabilities held on revenue account at the so those assets liabilities which are of revenue nature, working capital nature, those the gains losses will stay in the books, they will be taxed. But those which are on capital account, which are of capital nature, revaluation surplus, for example, or if you look at the other comprehensive income, you will find at a later stage that the tax, there was a decision later on that came. I think it is still that 114. There is a category which will never be reclassified to uh, income statement. Sometimes such gains come in which will never be reclassified to income statement. The corporate tax law says that we have to include such gains in the taxable income for the year. Okay, so these are the two alternative treatments on which we can consider unrealized gains and losses. So all of these various adjustments will need to be made: release, deductions, transactions with related parties, tax laws. So once we have done all of these adjustments,
You're not audible.
sorry, can you guys hear me now?
Yes, sir.
Okay.
Yes.
So one more ministerial decision is there, which is called ministerial decision number 120 on adjustments under the transitional rules for the purpose of this decree law. So that decision also contains a lot of guidance on what adjustments need to be made. And another very detailed decision is ministerial decision number 134 of 2023 on general rules for determining taxable income. Actually, if you ask me, the biggest decision is this ministerial decision number 134. This contains very detailed guidance on what different adjustments, what different treatments need to be made for determination of the taxable income. But in short, what I'm telling you is that once you have done these adjustments related to unrealized gains and losses or disallowed expenditure and all that, you will, bottom line, you will reach at the taxable income. And on that, then you will apply the tax rates. Third rule we are looking at: for the purpose of calculating the taxable income for the relevant tax period and subject to any conditions that the minister may prescribe, a taxable person that prepares financial statements on an accrual basis may elect to take into account this we just read: assets and liabilities, unrealized gains. Unrealized gains and losses on all assets and liabilities can be booked on a realized basis, subject to adoption of a fair value or impairment accounting, while such gains or losses on all assets and liabilities held on capital account can be booked on realization. So that's the alternative treatment. Again, this was covered, this was also detailed in ministerial decision number 134. Another rule: for the purpose of Article 20, the following are defined: assets held on capital account, liabilities. Let's look at assets that the person does not trade, assets that are eligible for depreciation, or assets treated under applicable accounting standards as property, plant and equipment, investment property, intangible assets, or other non-current assets. Clear? These are assets held on capital account. Then we are looking at liabilities now. Liabilities, the incurring of which does not give rise to deductible expenditure. Beautiful definition. Very easy to understand definition. So if the liability arises which does not give rise to deductible expenditure, which liabilities give rise to deductible expenditure? Usually it is the working capital liability, trade payables or other stuff, accounts payable, falana utility payables, etc., etc. Under the chapter 9 of the decree law, or liabilities treated under applicable accounting standards as non-current liabilities. These are liabilities held on capital account. And then the revenue account ones, asset and liabilities other than the ones that we have just discussed above. Unrealized gains and losses. An unrealized gain or loss includes unrealized foreign exchange gain or loss as well. So when working out which assets or liabilities, gains and losses, including exchange gains, can be booked on realization or accrual basis, assets on capital account are fixed on current assets held for the long-term business use, and liabilities are usually those which do not give rise to deductible expenditure or non-current liabilities. Another rule comes in. Minister of Finance may prescribe any of the following circumstances and conditions in which a person may prepare financial statement using cash basis accounting. So that's a very rare scenario. Any adjustments to the accounting standards to to be applied for the purpose of determining the taxable income. A different basis for determining taxable income of a qualifying business activity. So there is this ministerial decision number 114 addresses accounting standards and methods basically. So it details the provisions of how to record and whether there are any adjustment needed. Rules 6 and 7, let us have a look at these rules as well. Subject to any conditions specified in that Article 20, taxable person can make an application to the authority to change its method of accounting from cash basis to unrealized basis from the commencement of the tax period in which the application is made from the commencement of a future tax period. So you can change your accounting method from cash to unrealized. In case of any conflict between the provision of the decree law and the applicable accounting standard, the provision of the decree law shall prevail. And this has actually happened, especially for those items which will never be reclassified to income statement, OCI items. So in prescribed circumstances, cash accounting may be allowed, and if the decree law provisions conflict with the accounting standards, decree law shall prevail. So very rarely cash basis is allowed. Now we have come to another article which is called small business relief. I'll quickly run you through this. So some entities are very small. Their revenue does not reach 3 million dirhams. It will come. The revenue, the gross amount of income derived during a tax period of the taxable person for the relevant tax period and previous tax periods does not exceed a threshold set by minister. This threshold is 3 million dirhams. Here you can see this 3 million dirhams. Okay. The minister has not, the taxable person meets all other conditions prescribed by the minister. So in short, if a small company, and this is a strategy point, guys, you will find certain taxpayers or companies who come to you for advice. So don't do a brain surgery for someone who can be cured with a Panadol. Don't get them to file a tax return if their annual revenue is not 3 million dirhams. Okay, they can opt for a small business relief. So ministerial decision number 73 of 2023, which it is issued, and 3 million dirham is the threshold. Is this point clear to everyone? And this is not profit, we're talking about revenue. So and it should be 2 years. Please remember, we look at 2 years revenue, the relevant tax period revenue and the previous year's revenue. Both of them should be below 3 million dirhams. Okay. The relief is only available to UAE residents who elect and provide the revenue does not exceed a threshold. When does it apply? Article 21 applies to taxable person. The following provisions of the decree law shall not apply. So if you are going into small business relief, what is the consequence of a company taking the small business relief option? Exempt income will, they will have to ignore all of that basically. No, they will not consider, okay, we had exempt income due. So it becomes kind of a tax holiday. So for that company. And it is available until 2026. Okay, it will be written somewhere down there, but I'm telling you quickly. So exempt income will not be available. Reliefs will not be considered. No deductions will be considered. Tax loss relief, carry forward of tax loss, that will not be available. Transfer pricing documentation will also be not available. So in effect, the company will be enjoying the tax holiday. But a question should come into our minds. And since the only person, maybe Farjad can answer this in addition to Abbas, but I don't know about Haya. But why would we consider transfer pricing documentation for a company which is so small that it is hardly earning 3 million dirhams? Can somebody give me this answer? Shouldn't we think on these lines as practitioners?
Because maybe they have shifted their profits.
No. Abbas?
Mhm.
Farjad, Abbas, or who else is there? Absar, anybody
I
else?
think you're still
There is
needed
a
to ensure arm's length transactions are being done.
Okay, anybody else? Yeah, someone was saying, who was that? Farjad, you were saying?
Yes, sir. I was of the same opinion that company might be reducing their profits, and major sale and purchase of the company is from the related parties.
No, that is not the case. Actually, see, bhai, sale and purchase, that's an entirely different story. Tax fraud, basically reducing, artificially reducing, right? Okay, let me give you a hint. Do you guys remember the types of regimes that are in place in UAE? That's a big hint if you can pick it. We read there were 5 conditions that some types of companies have to comply with, 5 or 6 conditions. One of those conditions was transfer pricing document and compliance with arm's length transaction. Other conditions were they should have economic substance. One more condition was that they should be earning qualifying income. You know, they should not opt for normal tax regime. You remember that? Article 18, guys, come on. Qualifying free zone person regime. Don't you remember that for qualifying free zone persons, irrespective of the size of their revenue, they have to maintain transfer pricing documentation? Do you remember that? We discussed that, we read that, and you guys have forgotten it. Okay, anyways, and let me tell you that what you have forgotten is probably the biggest matter of contention right now in UAE in corporate tax. Qualifying free zone person, because the largest number of businesses operating in UAE are involved in trading. And this was the biggest point of hue and cry. As a matter of fact, because of this regime, FTA and Ministry of Finance itself, Ministry of Finance, which is the mother of FTA, they themselves changed their stance. When in May 2023, when for the first time qualifying free zone regime decisions came, the entire trading community of UAE, they protested, they raised so much hue and cry saying that, sir, we have high sea sales going on. The decisions that you have given, they apparently you have used the word that trading activity should happen in or from a designated zone. If we do that, then we will be subject to very huge amount of corporate tax. So what do we do in this? So FTA heard them, and later on, after discussion and Ministry of Finance heard them, and later on in a seminar, they identified that don't worry, your high sea sales will still be considered as qualifying income. So guys, please don't forget these very, very critical things. Under qualifying free zone regime conditions, they have to maintain adequate substance. They must drive qualifying income. They should not elect to be taxed under normal tax regime under Article 19. And this was the reason I asked you this question. Complies with Article 34, which is arm's length principle, and Article 55, which is transfer pricing documentation. This is a requirement of qualifying free zone person regime. Okay, now do you understand why they would write Article 55 here? If it is such a small company that it is earning only 3 million dirhams of, or less than 3 million dirhams of revenue. So it can be a qualifying free zone person. But again, another thing will come into play that, if someone is someone meets the criteria of qualifying free zone person, why would that person consider going into small business relief regime? So anyways, I will leave this to you. This is why we call it a game of chess, corporate tax. Think about it. These are the things that you guys need to play with. Okay. This means that when an effective election is made, the provision which determines income expenditure is to be taxable or deductible, C's being relevant. So all of these things will become irrelevant. It will be a tax holiday for the company. Small business relief. Evidence. So yeah, FTA may ask evidence that you are claiming small business relief. Were you actually, meeting the criteria? FTA may take necessary measures to verify the compliance with the conditions of Article 21 and may request any relevant information or records for ensuring that the company was meeting the conditions of small business relief. Now we have come to another part of it, which is Article 28 and 29, which is on deductible and deductible expenditure and interest expenditure. So first, we will start with the deductions, right? Allowable deductions. The deductible expenditure in Article 28 is very important because it establishes the core rule by which deductions are determined, and FTA has summarized its position in the following manner. In principle, the FTA confirms all legitimate business expenses incurred what? Wholly and exclusively for the purposes of deriving taxable income. So that's a key criteria for us to remember. I think this is not new to you. In your respective other countries, India, Pakistan, or wherever you are from, you must have read this, right? In order for an
Yes,
expenditure to be
yes.
deductible, it has to be wholly and exclusively for the purposes of earning taxable income. So that only that will be deductible. But there can be, again, similar rules will apply. They can be mixed expenditure, right? For the purpose of business and other purposes as well. So in that case, pro rata expense will be allowed. Although the timing of the deduction may vary for different types of expenses and accounting method applied. So yeah, I mean, treatment may differ. For capital assets, expenditure would generally be recognized by way of depreciation or amortization. Can I ask you, in your view, is there a rate of depreciation or amortization specified like it is the case in India and Pakistan? Is there a rate of depreciation amortization for different types of expenditure and all? That's a quick answer. Anybody can give me this answer? No. Answer is no. No rate of depreciation has been identified. Whatever IFRS compliant financial statements contain, it is acceptable for FTA. Okay. FTA's position is found in Article 28. Yes. Somebody saying something?
Yeah. So just one thing. So when we say IFRS compliant, financial statements, it could be that a company, that let's say two companies have a different depreciation rate for the same class of assets. In that case, because as to my understanding, IFRS does not give a specific rate for depreciation for class of assets. So in that case, what would work?
The auditor would work. You get my point? See, that's where the role of the auditor comes in. So you are absolutely right. It can happen and it has happened. As a matter of fact, the standards allow it because methods may differ. Same class, even the methods may differ. One entity may be using a straight line method, other units of production or something else, right? So it can happen.
Yes.
But if it is in compliance with IFRS and the auditors endorse that, I mean, even auditors' requirement will not be relevant here. Do you know why do I say that? Can somebody comment on that? Why do I say that the auditor's requirement will also not be relevant here?
Because the FS are prepared under IFRS.
Because the mandatory audit requirement comes at a much higher revenue threshold. Does anybody
Okay.
know what is that revenue threshold requiring audit of the audit of the financial statements? It's 50 million dirhams. So if your entity is earning 50 million dirham per annum revenue, only then the company will be required to maintain audited financial statements. Clear?
Yeah.
Is there an exception to this rule?
Listed companies, I think.
Listed companies, okay, yeah, okay, fine. Listed companies are there's a that's a, but it's not a requirement of tax law. Listed companies have to
Yeah, yes, yes. That is
from
for corporate law.
from a corporate tax law. Is there an exception to the 50 million rule? Can I give you another hint, Abbas? You just read it.
Freeze.
Maybe not read it, but I have told you. Qualifying free zone person regime. If you remember that qualifying free zone person regime, the last category was meets any and other conditions specified by the minister. You read
Yeah.
it? You remember this?
Yes.
So that any other condition, when we go to the ministerial decision number 265, you will find that the audit has been provided there. That the qualifying, it is mandatory for qualifying free zone person to get their financial statements audited.
Okay.
Okay. I think this is the one. This is number 265, I think. Yeah, ministerial decision number 265. In this decision, you will find that the qualifying free zone persons are required to prepare audited financial statement, and irrespective of their revenue. If it is a qualifying free zone person, they must prepare audited financial statement. Clear?
Yeah.
So
Okay.
that, okay. Anyways, coming to the next. FTS position, expenditure incurred, yeah, that we read. So it came out of discussion. Fine. Let's move forward. HMRC in the UK confirms that when determining the meaning of wholly and exclusively, the rule is that the taxpayer's sole purpose for incurring the expense is for the purpose of their trade, profession, or vocation. That is solely and exclusively. If a non-trade purpose is identified, then the expenditure is not allowable. Non-trade purpose. In UK, the dual purpose expenditure is expenditure that is incurred for more than one reason. If one of the reasons is not for business purpose, the expenditure fails the statutory test, and there is no provision that allows a business proportion. Wow, that is very harsh. So if in the expense there is no you know uh, business purpose, if one of the reasons is not for business purpose, the entire expense goes for a toss. But see the comments below concerning expenditure when where an unidentifiable part of the proportion is allowed is wholly and exclusively for the purpose of business. Let's see. HMRC confirms that where a taxpayer incurs an expense wholly and exclusively for the purpose of their trade, profession, or vocation, an incidental benefit may arise. Yeah, very good. Incidental benefit may arise. Intention was not there, but some incidental benefit which was not trade related arose. Such an incidental benefit does not of itself means that the expenditure is disallowed. For example, self-employed consulting engineer may travel to exotic locations to advise on projects. The travel and the exotic locations may be benefits, but where there was no private purpose, they are incidental to the carrying on of the profession. That's why we guys love the audit profession, right? We have to travel to different places, and so that's an incidental benefit. It is anticipated the UAE will adopt meaning of wholly and exclusively substantially similar to that adopted in the UK. So it is on the same line. Deductions that are not allowed, expenditure not incurred for the purpose of business, expenditure incurred in deriving. This is a key part, man. You guys need to understand this one very importantly, because you can easily, if you are doing it for the first time, you may miss it. So in our income statement, we have to identify, sometimes there are expenses which directly and entirely correspond to exempt income. Those expenses we must make it a point that we take them out and accordingly increase our taxable income for those expenses, right? So since some of you have been doing practical impact assessments, right? So expenditures, there is a two-tier approach. of allocating expenditure to taxable and exempt income. What is that approach? Can somebody tell me? Allocation and apportionment. Can you know the can somebody tell me the difference between allocation and apportionment?
Apportionment, sir, is to divide an expense, and allocation is to allocate on a predefined criteria.
Okay, no.
I
Okay.
think I
Yeah,
think allocation would be for specific expenses, whereas we would have apportionment for, like, let's say, general expenses.
correct, right. This is the right answer. So, for example, Farjad, think of dividend income. Okay, resident dividend income. Like one company is earning or receiving dividend income from their investment in local UAE company shares. Okay. Now, in order to earn that dividend income, they had to maybe, for example, pay some fees to brokers, certain brokers, right? And it is this is the only income that is coming from their treasury investment with through that broker, right? So the entire fee that you have paid or commission you have paid to that broker, don't you think that fee or commission entirely relates to that dividend income, Farjad?
Sir, that would be solely relating to the dividend income.
Yeah, that's what I'm asking. Na? You are a finance manager or CFO, and you said, let's contact ABC brokers and ask them to invest our money into local UAE companies shares. Okay, they did that, and now income is starting to come. That income, which is the dividend income, resident dividend income, right? It is exempt under UAE corporate tax. If you did not know, I'm telling you now, that income is exempt. Okay, dividend income, right? So don't you
Okay.
think that the money we are paying to the broker, that only relates to that income, dividend income?
Yes.
So
Yes,
that
sir.
so that amount of money, expense, fee, whatever it is, we will need to take it out of our profit before tax, profit figure that we wrote. So in the adjustment column, we will have to increase our profit by that amount of expense. But at the same time, we will take out the dividend income also because that's an exempt income. Clear?
Got the idea, sir. Actually, in Pakistan, like dividend income is uh, it falls under fixed tax regime, means no tax deductions are allowed in that. But
Yes.
the salaries of the people who are managing that portfolios, so we charge their salaries to the dividend income or capital gain income.
Hmm. Correct, correct. So the rule that you follow, similar rule is applied here. The only difference is that in Pakistan, the dividend is subject to final tax regime, which is a separate block of income. But here in UAE, what we do is we don't create a separate block of income. We simply remove the exempt income from the profit. That's one, that's reducing the, that's taking out the extra income from the profit which was already exempt, right? So that our taxable income drops. But while doing that, at the same time, we remove the expense element relating to that income as well. So some amount of profit will be added back. You get my point, Farjad?
Yes, sir. And that is allocation.
And that is allocation. Yes, that is allocation.
And if and that traveling expense which we apportion on the basis of export and local sales, that is apportionment.
Correct. Yes. So the shared service cost will be apportionment. A very good example would be MIS cost, ERP cost, because ERP is supporting the
Yes.
entire operation. So we will have to, take the ratio between exempt income and taxable income and apply to the ERP, SaaS charges, software as a service charges, or for that matter, whatever AMC charges, and apportion it. And that portion which relates to exempt income, that we will have to remove from our profit. So it will be an add back to the profit. So anyways, going forward, losses not connected with or arising out of the taxable person's business, these will also be adjusted and removed. Such other expenditure as may be specified. Deductions that are allowed. If expenditure is incurred for more than one purpose, deduction shall be allowed for identifiable part or proportion of the expenditure incurred wholly and exclusively for business. An appropriate proportion of any unidentifiable part or proportion of the expenditure incurred for the purposes of deriving taxable income that has been determined on a fair and reasonable basis. So basically, reasonable basis and proportion. So generally, courts of law accept revenue-based allocations or apportionments, revenue-based allocations as well as apportionments. And the same thing has been identified in the corporate tax law as well, in the guidance and in the decisions. Yeah, but it does allow that it does give you the taxpayer an option, saying that if you have a better or more fair basis for apportioning the expenditure, you can go ahead. But if tomorrow there is a question, you will need to justify that. That's how it is. So usually as tax practitioners, we take the safer route. We simply use that route which even the court of law will accept, which is revenue-based apportionment. Interest expenditure. That's a key concept of the corporate tax law. So let's quickly go through it. Notwithstanding Article 28(2)(b) of the decree law, interest expenditure shall be deducted in the tax period in which it is incurred, subject to other provisions of certain provisions have been provided in Article 28, 30, and 31. We will see what are these provisions. So Article 29 confirms that for interest to be deductible, it must have been incurred, subject to the normal rules of determining when an expense is deductible. And let's go to the details of the interest deduction limitation. So there is an Article 30. Let's have a look at it. First rule, taxable person's net interest expenditure. We need to remember that the wordings that we are using here, or the corporate tax decree is using here, is net interest expenditure, which means the interest expenditure is the interest expenditure amount that is in excess of the interest income. So what we do, we take out the interest expense appearing in the profit and loss account. We take out the interest income appearing in the profit and loss account and take subtract it. So the net expense is called the net interest expense. And what is the maximum allowable deduction? 30% of the taxable person's accounting earnings. Now this, I'll tell you, was subsequently changed. The wordings that you see here, it's no longer accounting earning. It is tax EBITDA. Tax EBITDA earnings before interest, tax, depreciation, and amortization. 30% of it. But that's not the end of the story. You'll find another twist to it, which is called the safe harbor. We'll read the safe harbor rule for the relevant tax period. So first thing, what you have understood, net interest expenditure is deductible up to 30% of tax EBITDA. Okay, but there is another safe harbor rule. A taxable person's net interest expenditure for a tax period is the amount by which the interest expenditure incurred during the tax period, including the amount of the net interest carried forward, exceeds the taxable interest income derived during the same period. So if there is interest expenditure and there is taxable interest income, the difference will be the net interest expenditure. Rule number 3, the limitation under 30 shall not apply where the net interest expenditure for the does not exceed an amount to be specified. That is the safe harbor rule. They have not written the amount here, but I am telling you it is 12 million dirhams. At the time of writing has not specified, this is all wrong. I'm telling you that later on, this specified amount to be specified by the minister was specified, and it is AED 12 million. So the good news is that 30% tax EBITDA rule has been overridden. So up to 12 million dirham net interest expenditure is deductible. Clear, guys? The amount of net interest expenditure disallowed under Article 30 may be carried forward and deducted in the subsequent 10 tax periods. When we say tax period, predominant meaning is financial year, in the order in which the amount was incurred, subject to Article 31 and 32, 30 clause 2. Up to 10 years, you can carry forward the unexhausted net interest expenditure. Interest expenditure disallowed under any other provision of the decree law shall be excluded from the calculation of net interest expenditure. So there is some interest expenditure which is anyways disallowed. There's some categories. You will see, hopefully. This is an exception rule. Article 30, clause 1 and 5 shall not apply to banks, insurance provider, natural person undertaking business activity, any other person as may be determined by the minister. So banks, insurance, and natural persons, this interest limitation, deduction limitation does not apply. Why? Because their very jobs are, the business itself is dealing in the interest related matters, investments, borrowing, lending. So you can't place a limitation on them. And natural persons have been facilitated anyways. Minister may issue a decision to specify the application of Article 31 and 32 to a taxable person that is related to one or more persons through ownership or control, and there is an obligation on them under the applicable accounting standards for their financial statements to be consolidated. So usually in the consolidation, what happens is two scenarios exist. There is usually a parent subsidiary relationship or common control. By the way, common control under IFRS 10, if I remember correctly, you cannot prepare consolidated financial statements based on common control under IFRS 10. It has to be a parent subsidiary relationship, and the control may exist. Just common control may not be the criteria. So this is a summary of what we have already read, so I'm going to skip that. Ministerial decision number 126 on the general interest deduction limitation rule provides detailed rules for the interest limit deduction. Specific interest deduction. Now, this is key, and in the previous part, just now, when we were looking at the previous slide, we saw that certain types of interest are anyways disallowed, right? That's what we are reading right now. No deduction shall be allowed for interest expenditure incurred on a loan obtained directly or indirectly from a related party in respect of the following: a dividend or profit distribution to a related party. So, the company wanted to declare dividend or distribute profit, and for that purpose, they obtained a loan from a related party. Now, that is not allowed. That's a clear, architecture of, creating tax avoidance. A redemption, repurchase, reduction, or return of share capital. So these are activities of capital nature basically. So if you're taking a loan to redeem shares or do some equity changes, that's not allowed. A capital contribution to a related party. You want to invest money into another related party, and for that you are financing, taking a finance, that is interest on that kind of a loan will not be allowed. Acquisition of an ownership interest in a person who is or becomes a related party following the acquisition. Acquisition of an ownership interest in a person who is or becomes a related party following the acquisition. So yeah, so if you have acquired another company who will become a related party following that acquisition, so financing that transaction, that interest is also not allowed. So these examples that we just saw of where interest may be disallowed, that will be by default excluded from the calculation of net interest expenditure. Deductions for interest expense are not allowed when the money borrowed from, so this is a repetition of what we just read. Corporate tax advantage. Okay, now we need to remember, we need to focus on the word advantage. So in context of corporate tax law, wherever you see this expression corporate tax advantage, usually it will be referring to an undue or unfair advantage, okay, which is usually done for tax avoidance purposes. So let us read Article 30, Clause 1 shall not apply where the taxable person can demonstrate that the main person of obtaining loan and carrying out the transaction referred to this was to gain a corporate tax advantage. So, well, the taxable person will be too foolish to demonstrate this, but the authority will demonstrate it. They will, find out whether you did this to gain a corporate tax advantage. Why? Because you are deducting interest, right? So that is not allowed. You can't deduct interest. Okay. The limitation does not apply where the main purpose of obtaining the loan and carrying out the transaction cannot be to cannot transaction not to be obtaining corporate tax advantage. So this limitation, the above, limitation does not apply if it's a fair business deal. The meaning of corporate tax advantage is explained in the following modules. Okay, we are going to read in detail, but it is a topic of tax avoidance. For the purpose of Article 30, Clause 2, no corporate tax advantage shall be deemed to arise where the related party is subject to corporate tax or a tax of a similar character under the applicable legislation. So, for example, can somebody elaborate what is written in here? Can somebody comment on it after reading it carefully? Let's see how you can connect the dots. No corporate tax advantage. Yeah, you want to say something?
No, I was just gonna say that this if the if the company who's claiming the interest tax expense is also subject to tax law in a foreign jurisdiction, then it would be assumed that there's no corporate tax advantage being, uh, used, I think.
Yeah, so the idea is that if it is, I mean, particularly if it is related parties, because this Article 31 deals with the related parties, right? So if under this article, one party is giving the loan, other party is receiving the loan, right? The party that is giving the loan will earn interest income. The party that is taking the loan will claim interest expense deduction. So if these are related parties and both are subject to corporate tax, then at an economic level, if FTA loses on one side, it gains on the other side. Right? That's the concept that has been mentioned here. And foreign jurisdiction also same, or a tax of a similar character under the applicable legislation of foreign jurisdiction. I mean, the borrower or lender could be in a foreign jurisdiction also. So if this scenario is there, and in the other country, a tax of similar nature, such as corporate tax exists, then there are chances that it will not be seen as a corporate tax advantage. But we need to be careful because, uh, you know, this usually would happen between the related parties, and especially where one related party is significantly profitable and the other party is, making a loss. Usually, this is how this fraud is structured. Other than Abbas and Haya, can you guys tell me how a clever way a corporate tax advantage can be created between related parties through lending and borrowing, intercompany lending borrowing? Farjad or Kalima or any other person? Okay, since you guys are not speaking, I'll allow the two practitioners, Haya and Abbas, to comment on that. How can a corporate tax advantage be constructed when it can be created unfairly between two related parties through borrowing and lending?
Um, it it would be that the company with the higher tax rate would be lending the money to the company with the lower tax rate. So in
Abs
that, so what would happen that the company with the lower tax rate would um, have to pay interest at a lower rate on the income, whereas the company with the higher tax rate would be able to get a better advantage through using the interest. Yeah, sorry.
Yeah. No, correct. You're right. It's fine. So your example was cross-border example where one company
Yeah.
is in UAE, other company is outside UAE with a higher or lower tax rate. Now, let me ask Haya the question that Haya, let's say that the borrower and lender both are in UAE. What would be the chances? See, as tax auditors or auditors only, what we do is in Big Four, they use a terminology of WCGW, which is what could go wrong. Have you heard this terminology before ever? So, Haya, I want you to think about it and tell me that both borrower and lender are related parties and both are in UAE. And they are borrowing, one of them is a borrower, other one is lender. How could a corporate tax advantage be constructed here? Rate of tax is the same. So Abbas example has been excluded because Abbas entire purview was on two different tax rate. But if the tax rate is same and two related parties are there, what could be the reason for creating a corporate tax advantage? Haya, are you thinking or should I ask Abbas? Oh, I think Haya is not here. So, Abbas, would you like to comment on that?
Um, um, I can't think of an example right now.
Okay, what
Um,
what if one company was significantly more profitable and the other company was significantly loss incurring, and through creation of this borrowing and lending, uh, only one company's tax position would uh, get an advantage. The company which was in high more profitable, start incurring expenditure, and they reduce their taxable profit, and the other company was so much in loss that even after getting
mm,
income they stay within the loss threshold
yeah,
or just below the taxable threshold.
yeah.
Don't you think that could be an example?
That could, but then, I mean, just thinking, if
Hello, I lost you, Abbas.
yeah, sorry. What I was saying is that if let's say the company is, let's say, in such huge losses, how would they get funds to, give to the other company unless by borrowing from someone else?
Yeah, so that's how organized crime or organized avoidance works, na? So you see, I've come across companies who cook their books, right? They may
Hmm.
have enough money, adequate amounts of money, but they cook their books and show the situation where keep one company as less profitable, other as but what I'm only
Yeah,
discussing is uh, to look at all possible
yeah.
scenarios, all possible
Mr.
scenarios.
Altaf, what you just told, do you mean like a profit split method when in transfer pricing they would do? like that between the group, like the two companies?
Okay, what you're saying is, analogy can be made of it. Analogy, yes, an analogy can be made out of it. But profit split would be, that's a very different concept. It would probably belong to transfer pricing only. But yes, this itself is a topic of transfer pricing. You rightly pointed out. The borrowing lending can be a major area of transfer pricing, and the concept they could pick from the profit split method and plan it in such a way that the company which is exposed to a higher tax exposure ends up reducing their tax exposure, whereas the other company tax position does not change. And as a matter of fact, if you look into the model tax convention commentaries, you might find exactly the same thing which I have just told you. This is still quite possible. Anyways, time is running out. I will have to move forward with this. So anyways, this was quite a lot of discussion on uh, interest deduction limitations. Moving to a relatively simpler, much easier area, entertainment expenditure, which is Article 32. I can summarize it quickly that there are two types of expenses basically that company incurs in terms of entertainment expenditure. One is for the staff, and then there is for everyone else. Okay. For the staff, if there is any entertainment expenditure incurred, it is all allowed, 100% allowed. For anyone else, which includes shareholders, which includes, customers, suppliers, whatnot, anything, the entertainment expenditure, only 50% of that is allowed. That's the summary of this article that I've just explained to you. Let us quick, the examples have been provided. Uh, these are not exhaustive examples, but these are the key examples of entertainment: meals, accommodation, transportation, the admission fees, facilities and equipment used in connection with entertainment events, etc., or other expenditure. These are the examples of how entertainment expenditure may work. Okay. So please remember what I just told you. This is for this 50% rule is for all other parties except for the staff. Sorry, let me go to the previous one. I hope, yeah, because I just read 100% here. Yeah, here. Uh, It is arguable, however, that the cost of transportation that senior executives from one business meeting to second business meeting should be 100% deductible, because the transportation was neither for entertainment nor receiving that senior executive. But see, specific cases will keep coming. You can never, it is not possible to cover all the cases, but the general rules we should learn. So anyways, we're coming to the non-deductible expenditure. So donations, grants, gifts made to an entity that is not a qualifying public benefit entity. So there is a approved charities list actually. So only that is again issued by cabinet. I think the decision issued by the cabinet number 37 2023 regarding qualifying public benefit entities. So those entities that are listed in this decision, if a taxpayer gives donations to these entities, it will be accepted as allowable deduction, otherwise not. This is a key thing. I think just a few days back, this question I was discussing with Usman also. Fines and penalties other than amounts awarded as compensation for damages or breach of contract. Okay, fines and penalties are non-deductible expenditure other than amounts awarded as compensation for damages or breach of contract. Example, an administrative fine imposed by the FTA for filing late is not a deductible expense. But compensation for damages or breach of contracts, this is which article? Article 33. This will still be charged. Okay, somebody breaks contract, they have to pay damages, right? That is an income, taxable income. Bribes or illicit payments, again, these are disallowable deductions. Dividends, profit distributions or benefit, these are capital nature expenses. Sorry, not capital nature transactions. These are not expenses. These are distributions. So they are not allowable deductions. Amount withdrawn from business, obviously these are drawings. So this will not be considered as.
Basically, these distributions are from after tax profit, right?
Yeah, exactly. Distributions are when we talk
The
about
expense after
yes.
tax.
Yes, so these are in nature of drawings and dividends, right? Okay. Uh, if there is a corporate tax imposed on taxable person under naturally corporate tax liability, that's not an expense that can be deducted. That's something that you have to pay to the authority. Now this is important. This is the key point. Input value added tax. Input value added tax incurred by a taxable person that is recoverable. So you can recover this tax while filing your tax VAT return. That is not an allowable deduction referred to in the preamble water pay. That raises a question, Abbas, because I think you or Farjad also knows. Even Kalima would know. Maybe Haya will not. But what about blocked input VAT? That input VAT which you cannot recover in VAT return. What would you call that? Is it an allowable deduction or disallowed?
It would be an allowable deduction if you cannot claim it.
What is
Yes.
what is your view, Kalima and Mujaddid?
Because they have specified here only recoverable ones are disallowed, then the other one not recoverable will be allowable.
Yes, correct. All of your understanding is right. That blocked input VAT is an allowable deduction. Tax imposed on income outside the state. Tax on income imposed on the taxable person outside the state. This means that the taxes paid to the foreign tax authority are not deductible when computing a taxable person's tax base. Yes, this is a tax credit. You don't deduct tax credit as a
Yes.
allowable deduction. Tax credit you deduct out of the liability. Other specified expenditure, such other expenditure as, and besides, it will be foolish to deduct a tax credit as a deduction. Am I right, Haya? Tax credit reduces directly your corporate tax liability. If you take it above
Tax
and
liability. Yes, you are very right.
if you take it above, by the
It
way,
reduces tax liability.
Just to I'm sure some of you might know, but just for recall purposes, I'm telling you that we have always discussed two types of reliefs when dealing with cross-border taxation, right? What were those two types of reliefs? Can somebody tell me? One was called the credit method. Other one was called what? Exemption method. You just read foreign permanent establishment, yeah. You guys,
Yes.
today you read it, right? Foreign
Yes,
permanent.
either we opt for the exemption.
Either we opt for the exemption or we opt for the tax credit. Correct?
Tax credit.
Yeah.
Yes. Yeah.
This point that we are looking at in model tax convention, third method has been identified, but the commentary exists that this is a rarely used method, which is deduction. So the tax that you paid in a foreign jurisdiction, you I don't know which country would put this provision, but it could be a possibility. Maybe there is some very few countries exist that allow that foreign tax paid as a deduction, or they require it as deduction. They don't give it as tax credit, which is a very rare and strange thing, but and it is not the best of policies to support taxpayers in a country. But this is the third double tax relief identified in the model tax convention. I don't know if any one of you understood what I just said. Did you understand?
Yes, understood. Yeah.
Okay.
Well, it will reduce reduce the taxable income basically.
Correct. Yes. So if you allow the foreign tax
Yes.
credit as a deduction, it will only reduce a little bit of your taxable income. But if it were allowed as a tax
Taxable
credit,
income.
It was, if
Yes.
it were allowed as a tax credit,
It
that
will
will be a much
reduce tax liability.
liability. Yes. So, anyways,
Yes.
other yeah. So, any other deductions, if they are there, it will be identified by the minister. Corporate tax rate. Corporate tax shall be imposed taxable at the following rates: 0% and 9%. So 0% is for the qualifying free zone persons, and okay, okay, right. This is the normal tax regime we're reading. So basically, in short, on the first 375K, the rate applied will be 0%. Is it wise to call it exempt, or is it zero rated? The first slab of 375,000. Usually, whenever
No,
It's
uh,
zero rate.
zero
correct.
rated,
For,
zero rated, not exempt.
Farjad, when we are Farjad, when we talk to clients here in UAE, so many tax practitioners say that, yeah, your first 375,000 dirhams are exempt. That's what we say, right? Usually, quite a few people. Is Farjad there or left the call? I think Farjad is there. Anyways, the point is, it is not exempt, it is zero rated. First 375,000 is zero rated, and there was a decision, actually 116 of 2022, which specified this limit. That's one point. Secondly, one more thing was that in the same decision, they highlighted something which internationally is referred to as fragmentation, anti-fragmentation rule. So they said, you can't artificially fragment your activities just to stay below the 375,000 radar. So that's the law. So if it is an artificial separation of business, FTA has the right to consider it as as one taxable person, and they can increase the tax liability by seeing two entities as one. So anti-fragmentation. Okay. And then naturally above 375K, 9% tax is applied. Again, it is mentioned in ministerial decision number 116. This is an extension of Article 3 of the decree law. Article 3 is that key article which gives the different tax regimes. So just a memory check, how many tax regimes are there in UAE in terms of rate?
2.
2. Are you sure, Abbas? I don't
Yes.
expect this answer from you.
4, 0 standard exempt and out of
Come
okay.
on, guys. Okay, that's why I asked this question, because the most intelligent people in my course, like the people who are experienced, are going to give me wrong answer of this question, which is the basic level question to ask in corporate tax. So let me show you why did I ask this question. Article 3, right, Abbas?
Yes.
So what is you can see the first regime as 0% and 9%, which is the normal tax regime, correct?
Yeah.
Then
Yeah.
the second regime we see as what?
Qualifying
Qualifying
free zone.
reason person regime, correct? And the hell is it? What about this? Why did you forget this, Farjat? You remember this? Oh, sorry, Abbas.
Yeah.
Top-up tax regime. Bhai, top-up tax regime is there. This is Federal Decree Law number 60. I knew others will not be able to answer, but Farjad and Abbas should have known this. At least these two people, and Kalama should also have. Haya is new, but it's all right. So please remember this point, guys. Please remember this point. As per this Decree Law number 60, the Article 3, Clause 3 was introduced. In the original decree law, you don't find clause 3. Okay, you only find clause 1 and 2. That's it. But this decree law number 60 introduced third clause, which was on top-up tax regime. Okay, so minimum top-up tax of minimum global minimum tax of 15% has been introduced. This is the third regime of tax. So now anyone asks you how many regimes are there in the corporate tax law? 3 regimes are there. Normal tax regime, qualifying free zone person regime, and top up tax regime. Okay, anyways, moving forward, we come to the knowledge check. Right. Select all that apply. Which of the following are considered as permanent establishment in the UAE according to the FTS commentary? An office where management and commercial decisions are made.
Yes.
A place where non-residents business activities are regularly conducted by a UAE resident on behalf of the non-resident.
Yes.
Yes. Okay. A factory producing ceramic tiles in India.
No.
A residential property.
Yes. No, sorry. It's India.
A residential property owned by a non-resident individual in the UAE. A residential property owned by a non-resident individual
Yes.
in the UAE.
I think no.
It is no. Why? Because this is not
It will
permanent.
be
UAE.
earning the
It is a UAE sourced
Is it?
income.
yeah, no, source income.
It is UAE sourced income, not permanent
Yes.
establishment. Okay. Let's go to the next one. Which of the following persons is liable to corporate tax on its taxable income derived from UAE or from outside UAE? Which of the following persons is liable to corporate tax on its income, taxable income derived from the UAE or from outside the UAE in accordance with the provision? Natural person who conducts a business in the UAE. By natural person who,
Yes. I think it
yes, it
is.
is yes.
Yes.
A non-resident person who derives UAE sourced income.
Yes.
Yes,
Yeah.
yes.
No.
No, it is yes. Why? Non-resident person who's deriving UAE sourced income is subject to tax. The only thing is that
Yeah.
he is not required to register, unfortunately. It doesn't mean that he's not subject to tax. If he does not register, he has been kind of given a way around it, but he is subject to tax. Third, a juridical person incorporated or recognized under the applicable legislation of a foreign jurisdiction that is effectively managed and controlled in UAE. Poem.
Yes. Yes. Fine.
Foreign company managed in UAE. Okay. What about this one? Which of the following is an example of UAE sourced income according to this section? Which of the following is an example of UAE sourced income? Income received from a non-resident person in connection with a permanent establishment outside UAE. Person be non-resident, permanent establishment is also out of UAE. So it will not be selected. Income from the disposal of shares or capital of a non-resident person. Income from the disposal of shares or capital of a non-resident person. The share and capital belongs to the non-resident person. But what about the company in which that share capital is there? So it's a vague statement. Don't you think so?
Resident.
The company could be UAE company.
Yes.
And if it is a UAE company and there is an income from that from disposal of shares and capital, even if it is a non-resident person, it will be subject to UAE. But if it is a company not in UAE, then it is out of the scope. So this is a vague question. We're going to just assume it is a wrong question, but we are going to assume that this is disposal of shares of a UAE company, shares or capital of a non-resident person in a UAE company. Okay, I'm just clicking it for the time being. Income from a contract. Okay, this is one, right? We can look at others as well. Oh, it's a one option. Right. Which of the following is an example of UAE source income according to the section? This we left. This is vague. income from a contract that has not been performed or benefited from in the state. So it is, I mean, if the contract has not been performed or benefited in the state, then this is not UAE source income. Don't you think so?
No, it's not.
And let's look at the fourth one. Income received from a non-resident person in connection with a permanent establishment of that non-resident person in the UAE. Now, bingo, this is the one. Permanent establishment of
Yes.
non-resident person.
So income
This
is
seems to be the best option, right? So let us submit. Okay, let's see fourth one. Which of the following conditions must be met for an investment manager to be considered an independent agent for a non-resident person? This we learnt, we read, right? Let's read. The investment manager is engaged in the business of providing investment management or brokerage service. I think this was applicable, right? He should have a trade license, right, of the investment manager. Transactions are carried out in the ordinary course of investment manager's business. Yeah, I think this also we read.
Yes.
The investment manager is not the non-resident person's representative in the state. Yeah, I think this was also applicable in relation to any other income or transaction that is subject to corporate tax in the same period, right? I have to, this was also there.
Yes.
Okay, correct. Let's go to the next one. True or false? Expenditure incurred to book a desert safari for a business customer, not staff, visiting from UK is fully deductible for corporate tax purposes.
False.
false 50%.
Only 50%.
Correct. Select all that apply. Which of the following provisions do not apply to a taxable person? Which of the following provisions do not apply to a taxable who elects to be treated as not having derived any taxable income for a tax period under Article 21 of the decree law? What was Article 21, by the way? Article 21. Okay, we have to
Small
Google.
business relief.
Small business relief. Yes, very good. So, yeah. I got so many decisions. Okay. So I will trust, yeah, small business relief. Okay. So, so let's read it. Which of the following provisions do not apply to a taxable person who elects to be treated as not having derived any taxable income for a tax period under Article 2? So, under small business relief, things go out of the purview, right? What were those? Exempt income, that will not apply, right? We read. If you have gone for a tax holiday, then exempt income will be disregarded. What else? Income tax credits as specified in chapter 10 of the decree. Tax credits, I don't recall this reading in this non.
No,
It,
no.
yeah, it is not there. Okay. Reliefs as specified in chapter 8 of the decree law. What is chapter 8 of the decree law? Yeah, but I mean, I don't have to even look at it to answer this. All reliefs will be disregarded. If a person is taking the small business relief, all reliefs will be disregarded. Don't you think so? Similarly, deductions will also be disregarded. Right?
Yes.
No deduction, no relief, no. But this was not there. Income tax credits.
No tax loss relief.
Yeah. So let us submit. Okay. Select the correct answer. Which of the following statements is true regarding dual purpose expenditure? That should be an easy one. If an incidental benefit arises from the expenditure, it is not allowed. That was in UK. A business proportion can be allowed for the expenditure. This seems right. Expenditure is not allowable if one of the reasons for incurring it is not for business. This was the harsh rule in UK. The deduction for such expenditure depends on the accounting method applied. That is not right. So I think this one seems to be the best choice. What do you think, Aya?
Yes,
Okay, let's see.
this one is the best option.
Ah, okay. Which of the following is true about general interest deduction limitation rule under Article 30? So let's read these choices. The net interest expenditure for a tax period is the amount by which the taxable interest income derived during that period exceeds the interest expenditure incurred during the same period. Is that the correct one?
No.
No, interest was actually is the amount by which the taxable interest in this is reverse
No,
order.
interest
Reverse
It's a
order.
income
reversed
would,
one, yeah.
Okay, the interest expenditure disallowed under any of the provisions shall be included in the, no, this was, if it is disallowed, it will be excluded from the calculation. This is also not applicable. The 30% interest deduction limitation rule does not apply to banks, insurance companies.
yes,
Yeah, this is correct.
Yes.
Yeah, this
The
yes,
MOF has
this is true.
limited this time period. Now this okay, perfect. Uh, then we come to ninth. Which of the following types of expenditure are eligible for a 50% deduction under Article 32? Let's read. Meals for business partner. I think this was meals for business.
Yes,
Correct. Rent for all, no. Advertising, no. Office supplies, no.
no,
So this is the only logical
no,
choice, right? This is the
no,
only choice.
yes, meals.
Okay. Correct. And then we reach 10th. Which of the following expenditure are not deductible for corporation tax purposes in UAE? Amounts withdrawn from business. Withdrawals. So this is drawings, right? Corporate tax imposed on taxable person under decree law. This cannot be a deduction, right? Which of the following expenditure? This is not allowed deduction. Input value added tax incurred by a taxable person that is recoverable under federal decree law. This is not allowed. This you have to charge. This is an asset. And then we have tax paid to a foreign tax authority. This will also not be allowed deduction. That was the question, right? Which of the following expenditure are not deductible? Not deductible. This is not deductible. Corporate tax imposed on taxable person under this decree law is not deductible. Value added tax, which is an asset, it is not deductible.
All of
Tax,
them.
all of them are correct. Yes. So let's see. Yep. Okay. Perfect. Great. So I hope you guys added value from this. So this is what we have read today. Determine the taxable income for the resident, non-resident, examine permitted adjustments and those recognizing the circumstances, and then determine the rate which is to apply to the taxable income and the threshold before which the tax rate is applicable. So thresholds, yes. Now complete tax base and taxable income. Okay, perfect. Great, guys. Inshallah, let us reconvene. So as we I have a situation actually at office. That is why I had to change Saturday to Sunday. Thank you very much for joining the call. Inshallah, next Sunday we will reconvene. Okay.
Okay.
Okay. Take care. Thank you.
Thank you.
Thank
Bye.
you.
Thank you. Bye.